Hit it.
It's Friday, January 27, 2023, episode 205. I'm Patrick Ceresna.
And I'm Kevin Muir. This week we have the great pleasure of welcoming Charlie McElligott from Nomura Securities. We do something a little different from Charlie's other podcast appearances. We learn how he became one of Wall Street's most celebrated strategists. But don't worry, he also shares with us some insightful views about why markets have been running so hard in January. Then it's time for Talking Charts with Patrick Ceresna. I've run out of witty things to say about his technical analysis, which is awfully fitting because I think he's run out of smart things to say about the market.
We then end with our new segment, which is a go now. Give Kevin's crazy idea another try. Then we are skipping No Stupid Questions because the show is just too long, but we'll bring it back next week. And then we'll do settle up the skin in the game. So folks, stick around, and we may even drink some beers along the way. So we got a great show. Lena, hop on. What beer are Kevin and I drinking this week?
So this week, the guys are drinking Flying Monkeys, Space Age Sunshine, Orange Creamsicle, Quadruple IPA.
Quadruple? I think this is actually my fault.
It is your fault. You picked this.
I think I did.
And when I picked it up and I realized it's 11.6% alcohol.
Oh, jeez.
Oh, my God.
We are going to be slurring by the end of it.
You guys are going to look like this bunny on the can after
Actually,
can.
you know, it's pretty good. It's not really a beer. I wouldn't call it a beer.
If you can get past the punch in the face when you take your first sip.
It's definitely got a little bit of zip to it. Like, there's no doubt you're definitely tasting the alcohol.
Let me read you the little bit from the beer. The saga continues in a quadventure, continuing the galactic mission of Sparkle Puff. The fluffy armada of Sunshine Warriors channel the crystal star power of the ancient cat with a quadruple IPA, warming the edges of the void and flooding the galaxy with thermal bolts of belly-warming goodness. Bask in the ongoing adventures of the Flying Monkeys.
You know what? It reminds me, it seems like a Bitcoin beer, doesn't it?
Yes.
Seems like something the Bitcoiners would like.
No,
listen,
it's got lightning eyes.
It's got lightning eyes. All right. Okay. We're already giggling. Okay, let's go to Charlie and the first interview.
Well, you got to give me some disclaimer and side effects.
I do have to do that. I'm already blowing them. Okay. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics that mentioned in this show. Side effects of too much huddle may include meme stock migraines, precious metal preapsism. I don't know how to say that. And Dixie dysfunction. Actually, as well.
I've had Dixie dysfunction.
Yeah, who hasn't? It's something, you know what? It happens to everybody. Okay. Just a quick note. I am speaking next weekend at Mike Campbell's World Outlook Financial Conference in Vancouver. And please come to that, see me. But if you can't come to that, I think we should do a Market Huddle mini meetup Friday night at a bar. Just for anyone who's interested that wants to come, just email me, Kevin at themacrotourist.com, and include in the subject bar location. So and then I'll email you back wherever we figure out where it'll be. I haven't figured it. Like I haven't done any work yet. I haven't thought that far ahead, but we'll figure something out. It'll be Friday night, and it'll probably be a little bit later because I have some stuff to do. But maybe 8:00-ish, and we'll figure it out. Anyways, I'd love to see you guys for a little mini meetup. It'll only be a couple hours because I do have to speak the next day. I'm not like Patrick going out all night. Okay, enough talking. Let's get on. Get go to Charlie. It's our great pleasure to welcome to the show the cross-asset macro strategist of Nomura Securities, Charlie McElligott. Charlie, it's been a long time, and you've been on that other podcast a few times, but you never had a huddle experience, so thanks for coming by.
I'm psyched to be here, Kevin. It has been a long time. Our interactions were incredibly long ago when we first started, and you with the tourist, and my prior bank experience. So it's really nice to reconvene with you and catch up.
Oh, it is. I'm looking forward to it. Why don't we just kind of jump in terms of your career? Because I think although a lot of people know, your famous note, your institutional note that, by the way, is just available for institutional clients of Nomura. I know a lot of people, retail folks want it, but unfortunately you have to be an institutional client of Nomura to get it. Your note is passed all around Wall Street. It's something that is kind of a fixture, and everyone always talks about Charlie's levels, and you're kind of you're larger than life almost. But how did you get there? Let's go through your career in terms of like, did you always want to be in part of Wall Street?
Well, first of all, I truly appreciate the kind words. Look, I going into my senior year of college, I was spamming resumes anywhere I could find, and I think the fact of the matter is that a lot of my peers, folks that I was close with in college that had previously graduated, and my football team in college, my fraternity in college, all those things, I did see some characteristics that overlapped of my own with people who had gone off into the markets side of finance. I think at that point my school was a pretty big Wall Street feeder, but
So where did you go to school?
I went to Dartmouth.
Okay, you went to Dartmouth. And did you
the-
play
the-
football?
I did.
Okay.
My body fell apart, and I think I stopped after my junior year. But yeah, for a while there, it was a big part of things. And honestly, the generic kind of work hard, play hard of Wall Street matters. But I think to me, I was very interested, and I was a government major, a political science major. I liked, higher level kind of macro thinking, top down thinking, and if this then this kind of second order type of thinking. I was pretty into history, so when it came down to that decision about like banking versus markets and that kind of immediate gratification and tactical versus strategic and all those things, that was the spot for me. And
Okay.
it did work out that I was able to find a job in summer of 2001 actually, which was it was a tough job market at that time, coming off the bubble bursting.
Oh yeah. So you graduated in the summer of 2001, and Wall Street is laying off all over the place. How do you where do you land?
So it was pretty cool because, this is a big part of my story. I would say I was picked up by UBS, which at the time was, a real challenger bank into the kind of the global bulge area. And at that time too, you may know, they had that just built, not much before me, the world's largest trading floor up in
Right.
Stamford, Connecticut, which I think it was like equivalent to 3.5 football fields or something. I forget all the metrics on how many basketball courts you could fit in there and things like that. But what it meant was that as a new joiner, you had incredible access to information, whereas most banks, could only kind of contain certain parts of certain businesses on each individual floors in kind of the traditional New York City skyscraper. So you had access to everybody out there amongst the thousands, and that was a really big deal down the road. Certainly, as we kind of melted up into what ended up becoming the financial crisis, and my ability to learn on the fly. Which the other background point was that at that time UBS had bought a not so little hedge fund out of Chicago called O'Connor,
Oh, okay.
and those guys were were there was the home of Black Scholes, and so they were prolific in the option space and the risk space, and a lot of the kind of old O'Connor regime ran the certainly the equity side of things, the equities risk side of things there at UBS. So they took education, they took mock trading, risk centric stuff very seriously. And I remember thinking as a government major, in week one, looking at the Fibonacci books and things like that, and being drilled on options, mock trading and interest rate swaptions. I questioned my future viability a few times.
So you were hired onto the trading desk.
Yes, hired onto at that time, NASDAQ and listed New York Stock Exchange were separate desks. I mean, you were still kind of degrossing, you could say, from the bubble era. I mean, at some banks, at some competitors, some of those like NASDAQ desks had 100 traders. It was absolutely wild. We were obviously sized down at that point, but I think the bigger dynamic there was that as we had just gone to decimals, right? There was, you now had this kind of future consolidation that was happening. Um, you know, um, uh, electronic exchanges, direct access at the time, but dark pools, algorithms. We were one of my first jobs was every minute manually VWAPing slices of orders down to the floor of like the New York Stock Exchange. Like you had a schedule that.
I
remember the drill, right?
I remember, Charlie, because I remember people on. So I was a little ahead of you. I was probably a decade earlier, and right. I remember when the main desk got their first VWAP, and they were like, "What the fuck is this? Like, what do you want me to do?" And they used to complain, and literally when I remember the main desk, when they would get a VWAP, they would eventually just punt on it and go, screw it. I feel like it's a buy here. I'm going to buy it all here, and then say I missed the VWAP. But yeah, it was crazy because we did VWAPs by hand.
It was absolutely wild stuff. And you think about the firepower and the resources of these banks and whatnot. And ultimately, at the end of the day, you print out a spreadsheet and you knew that every minute I had to slice out, 100 shares, here and 100 shares there. And now, I was picking up fat tails in the end of the day, 200, 300 shares. It was absolutely ridiculous.
What's that joke that like all of the Wall Street or the global economy will collapse without Excel, like 2010 or whatever.
Right.
Like, it's actually shocking. Yeah, like it's shocking how much still runs on Excel.
You're not lying. You're not lying. I mean, people that switch banks. Nature of the game in this business. It's like sports free agency. You so often you hear it. You go to a new bank and there's intellectual property gets locked up that so you got to restart and rebuild a lot of things. And you go to a big name place and a lot of people are like, wow, this is surprising, because there is, at the end of the day, you're kind of running on, old gum and duct tape at times and Excel spreadsheets.
Yeah, an Excel spreadsheet that was made in 93 and just kept getting added on.
Kept getting layered onto. Yeah. Exactly.
All right. Okay. So you're at UBS. They got you doing this kind of like introduction to trading and you're on the equity desk. What's the next stage of your career? Like, how do you go? Where do you go from there?
Right. So, I mean, I was operating, in a pretty boom time still, particularly in that Nasdaq world. Think about like the, WorldCom bankruptcies and stuff like that, where, you're really seen at that same time as the internet boom, kind of hedge fund business really, growing quite prolifically. And I was with a sales trader who was a big time producer for us and was kind of his junior, and it gave me a lot of exposure to some serious funds at the time, Andor and Pequot, Masters of the Universe, and kind of like the TMT space, and with that you're kind of potted up with other types and some of the bigger hedge funds at that time, and you're picking up phones, you're getting a sense for the velocity and the urgency of things, and there's no time to suffer fools when you're under the gun, under the cosh. There's lights ringing off the hook, and guys are looking for capital on a couple million shares of something that's moving a percent at every 30 seconds. It was great exposure to the expectations, to the velocity, to the urgency of that leveraged fund space. Just as a backup, and then you're covering during vacations, and then you're picking up phones, you're getting to know these people, and you're getting out, and all those kind of career-centric things that are natural to the business. And you learn, that you've got to build that trust, but also too, you need content, right? This is no longer, even at that time, this was no longer about guys writing corporate cards, and this was also no longer about, starting around that time as we kind of pushed closer to the crisis. This was no longer about, earnings calls necessarily. This was no longer about balance sheets that there was, as I learned in that incredible trading floor of ours, much larger, more opaque forces at play. And that was really, the jump off spot for my career as the crisis began developing, going over and getting exposure to the credit derivatives guys, or the linear rates guys, or the rate vol, or the FX team. And certainly from my side of the floor, the options folks.
And did you do that on your own? You were just like, I want to understand how this is affecting my market?
Well, the UBS training program, the graduate training program, the GTP class. I mean, the beautiful thing about it, I think there was probably 50 of us spread all across both fixed income, interest rates, currencies, commodities, equities, all that good stuff. Was that you had people. You had interactions. You weren't, kind of lost, walking amongst the crowds. You had, folks everywhere. We had internal chats, obviously dialogues, helping each other out, asking questions. And it gave you proximity to information that, alone, on a floor like that, when there's a big economic data point, a big headline, the kind of the information sound, you feel it and hear it. You hear it kind of impact pockets of the floor. So that entire experience is when I saw that how big of a deal that this everything X equities story was to me, where it wasn't about that was honestly I just had to throw something at my dog.
Oh, that's all right. You know what? This is perfect Market Huddle content. We're not even going to edit this. This is you are like a true huddler. You're a true huddler. You got the dog snoring there, and you're throwing things.
It's 100-pound. It's 100-pound like baby Bernese Mountain Dog. Just absolutely sawing logs.
Yeah, I know. I have a Newfoundland, and she's about 100 pounds too.
Oh my God,
and as they get older, the breathing doesn't work so well. So you're at UBS, and do you think that was unique to UBS, or do you think that was happening, or is prevalent at all the other big banks, or do you think that was a UBS stress?
We just that group of ours, we had so many studs, and we had like the second youngest managing director ever at Goldman later. We had, heads of trading at a lot of big hedge fund shops. We had 3 guys that were, like the most senior traders at big name places, eventual heads of sales trading on sell side. I do think that the serious way that they approached your training, both, classroom training, as I said, like fixed income bond basics, to, required reading type of stuff, mandatory reading, as well as actual mock trading, which I think is a lost art. That's, you hear it these days. You see buy side traders that came up in a business where there's very little like shaping and mentoring, where, they still get bid off for wrong. I mean, it's absolutely shocking. The language is broken. It's a problem, and it drives me crazy. Yeah. And that was not the case there. So between that and then the access to information, and seeing that this world was not about, as I said, the corporate conference, the corporate earnings call, but instead it was about interest rate policy. It was about flows in other markets. It was about tail wagging dog dynamics. And certainly later is I've made a career out of, tracking kind of dealer hedging flows on top of, the growth of systematic strategies and passive and all these forces that end up being, oftentimes negatively convex, or end up being, short gamma type of flows that really dictate the underlying terms or the supposed, market narrative. It was fascinating to me. And, that's when my qualitative background, I realized like I needed to, it was a macro world. I needed to concentrate there. I needed to get quantitative skill set. And that really changed everything.
Okay. So I have a whole bunch of questions in terms of the development of your career, but I'm sure everyone wants to know, you're a young fellow working and covering all these hedge funds. Must have been some nice, some fun nights out in New York City.
It was different. It was a different time. That was the bottles and models era. I was young. I was, the funny thing is my eventual wife, I met day one in our training program. She was actually on the New York Stock Exchange desk. So, and is still in the business, as a matter of fact. So that dynamic, she got the joke with regards to expectations in that era, that in New York City, 2006, 2007 was just boom, boom. It was absolutely wild. And she was, participating in that kind of scene as well with regards to, staying in front of clients. That was a big part of the dynamic, because everybody was trying to, kind of buy their flows and things like that. And personally, I love going out. That was, my scene. That was my scene, but in my personal and work life. But I knew that's not what's going to cut it in this business. You needed to have a top-down view of the market. You need to be able to rationalize that view. You need to be able to support that view with actual data. And I got very serious on trying to educate myself, even though I was placed within equities, using that training background, using that proximity to information with regards to the rest of the the markets, to really get macro. And that started with kind of the accounts that I began to cover, where there was a lot of jump ball. Like a lot of equities folks were still just looking at like, oh, equity long short or mutual fund. For me, I got lucky and I stumbled into one of the largest quant funds in the world, who was not just doing high frequency trading, but was doing stat arb and risk premia kind of factor stuff, that brought me over the wall when they were experiencing their first huge growth. Macro funds, crossover credit funds, playing capital structure, where they were kind of like not left for dead by any stretch of the imagination, but they were, they viewed the world differently. Credit funds are very centric on economic cycle for obvious reasons, business cycle, and policy, from the macro side and the rate side. So to have that access, and then also to learn about kind of the flows from the quant side, was an incredible experience, especially because of what happened in the summer of 2007.
Okay, let's talk about that. So you're, by the way, are you still at UBS at this point?
Yeah, yep, still at UBS, and
okay,
we were,
so you're increasingly covering, increasingly covering these quant funds and taking a more macro view of the world, leaving alone the kind of go hedge funds that are front running blocks and stuff, and focusing more on adding value in terms of coming up with quantitative kind of value added in terms of bringing different macro and different asset classes together. Have I kind of got it right?
100%.
Okay, so what happens in 2007?
Well, I think it was January of 2007, January, Feb, early in the year, you got the first signs of issues. I think it was maybe HSBC wrote down their mortgage portfolio.
Yeah.
And as the housing market, the seemingly unstoppable beast that was the U.S. housing market that could never go down, began to buckle. And what ended up happening that over the course of that year, and then we saw what happened with Bear Stearns structured credit. But what was super fascinating to me, and goes back to this whole point about like the opaque dynamics behind the scenes that you don't realize kind of the flow on, was the famous quant quake, where for 1 week that summer of 2007, largely due to these seemingly esoteric dark pockets of the world, nobody knew what ABX was at the time. Although, you could go over and actually talk to our credit derivatives index guys to get a sense for what the hell it was. But and that was the beauty of that dynamic too, right? You could, before like the real crisis, there was, these things out there. You couldn't get it. You had to get a quote direct from a dealer. It wasn't ticking on an exchange. You couldn't really see pricing if you were even just a regular Bloomberg user. You had to be on runs. And what ended up happening within the equity, quant world, the market neutral world, was that, in the span of a couple of days, you saw, 30, 40, 50% moves in some in individual names, and even some market neutral factors, showing just this enormous knock-on effect as somebody was having to unwind.
Right.
And there was it was impossible to rationalize, but there was so much mimicry. Like if you thought about that world and how many of these folks were originated out of the same handful of firms, there was a lot of replication of these strategies, whether it was stat arb or kind of the more modern like Fama French type factors. And there was massive knock-on liquidations going through for very little explanation. And ex post facto, it was all related, seemingly, on the kind of the back test. Once you pulled apart, the story, it was all related to what was going on with the asset back stuff. Because as the story goes, It was supposedly, a very large bank asset manager, was basically having to make, a cash call for the destruction of their own structured credit stuff.
Okay, I didn't realize that. Actually, before we get into that, let's just step back and explain the quant crisis of '07, because although a lot of our listeners will be familiar with it, some might not be, and they might not realize that although we had, if you go and try to pull it up in the market, you can't really see any, like the indexes didn't do much, but yet, as you alluded to, different factors had moves that were, I can't remember how many sigma they were, but it was huge. And these quant funds all lost money at the same time. Can you just maybe step back and explain to people what it was and how it worked?
Yeah, there was, this idea of stat arb or market neutral long short. You're for whatever that source of alpha is.
Yeah.
The idea of a factor is like you're isolating, some sort of driver of alpha, some sort of driver of performance. The kind of the generic out of the box ones are, value, growth, right, momentum, dividends, low vol, things like that. If we're just looking at that sleeve of things, there right, might be simple like long Coke, short Pepsi.
Okay.
Or there's generally speaking in some of those, there's generally speaking a dynamic, some sort of like a mean reversion dynamic, a long one versus short the other.
Right.
But what you ended up getting was that you simultaneously began to see these unprecedented losses. Right, longs were going completely wrong way, getting hammered. Shorts were ripping, and it was so. And of course, massive dispersion. So to your point, like index wasn't exactly getting rocked out, right? There was just longs and shorts blowing up in very kind of crowded quantity names. And obviously like it was causing, huge stop loss. And that stress, was rippling through the market at 10 standard 20 standard deviation type of stuff and a quote normal distribution, which isn't what a market is. Markets are not normal distribution. Markets have fat tails. But as these stat arb strategies began getting rocked out just as quickly as it all was going down, and you're talking about at that time it wasn't just kind of up and coming quant funds at the time too, but this was a dynamic with banks, right? Banks had huge prop desks, they had huge stat arb desks, right? We weren't separated out at that time.
Ah, okay.
Yeah, and frankly, a lot of these guys, some of the biggest players originated in the prop side. So it wasn't just one of those situations where it's like dealers were looking at this calamity and from afar and being like, oh, that sucks. Like you were wearing it. A lot of people were wearing these issues internally. As things kind of came off and peaked out, by kind of middle of the week, and it became a talking point, then you started seeing the market break down. I think there was a 3% loss day or something like that by kind of mid end of week. But these losses proliferated, and you knock on into forced selling elsewhere, right? Selling liquid. And really that's what that backstory is, as I alluded to earlier. That backstory was, you're stuck in your illiquids, so you have to sell liquid. And in this case, the beauty and the curse of public markets is there's always, an emotional bidder offer to hit or lift.
Right.
And, these strategies, part of the selling point was just how liquid they are, but that also meant, that they were going to get the ATM treatment. And, these things got stopped out. It caused knock-on selling. It caused unwinds elsewhere. And as quickly as it came, then it went and reversed. And like by the end of the week, it was like over.
Yeah.
Because those things all got stopped.
It was unbelievable. And you think that this was caused by the first tremors in the ABX market?
Yeah, I think it was. As I recall, it was some of the mortgage stuff that was, really putting, some of that, structured credit and asset, securitized product, in bad spots, because everybody knows the deal there. Like they were, that stuff was leveraged so massively, and it just went, it just started going pear shaped at that time, and people didn't know. I think there's, we've seen some people try to parallel, risk bouncing now in the current market, I'm not going to jump ahead to, is this 2006 again, where there's like, or 2007, where there's this little bit of a head fake and a recovery and a rally, even though everybody, quote unquote, seemingly knows that, you're violently moving fast into imminent recession later. At that time we didn't know that still, but it seemed incoherent at the time. To know that there was all of this kind of trouble bubbling up in pockets, but the band played on.
Right.
That was just the nature of Wall Street at the time, and people were so used to just things kind of working out, and Wall Street was printing, and people were getting paid. And again, I was still relatively junior in that at that time, but to me, I was fascinated by this seeming calamity under the hood that 99% of people did not know about.
That's great. And so now the crash comes, or the crisis. Do you stick it out at UBS, or when do you make the leap to the lion?
Well, you get this joke, I think, here, as far as my next move. There was a period of time there in 2008 where we were worried about like the rule of law. Yeah. It was coming unglued. Like, could people, back up what their financial obligations were? It was thrilling and frightening. I remember I was took bunches of friends back to Ohio State. Like, I think it was an Ohio State, maybe USC game or something like that. Maybe out in LA. It was a thrashing, unfortunately, but and a bunch of the guys, we were all Wall Street, and people's phones started like lighting up. I think it was like a weekend of Lehman. And dudes at biggest places in the world, like, we're all rough on Sunday, in the airport, and phones started blowing up, and it was like, shit, this is about to go down. And and you felt like, wow, I'm not a kid anymore. Like, I gotta get serious here. And look, in the next kind of 6 months, right, until we kind of made the lows in March, but it was about counterparty risk. You just didn't know who, and so it was. And the bank that I was at, took down an incredible slug of write downs, because they were part of what a lot of the other banks got caught up in doing. We had a hedge fund structure that got shut down quickly because they were doing a lot of the same stuff and buying the same stuff and levering it up the same way that stopped out a bunch of other people. So I made a career trade, a capital, kind of a balance sheet trade to RBC, like the Canadian bank side, which in that sense, as people collapsed in front of them in a relatively risk averse culture, I would say, but also too, a housing market that never really cracked throughout all that, as you're aware. And it was this incredible trade, because there were, really skilled group of people, some really, really bright people. And, when people were really focused from the buy side on counterparty risk, you got a great story to tell. Fortress balance sheet, the world's best credit rating for a major bank, and they were looking to take advantage. That was a great thing about RBC. They were always building when others were scaling back, and just kept adding really quality assets and people and skill sets and stuff like that. So I went and joined RBC and did their the sales trading business there, and eventually got into Europe and live overnight during that crisis, and the macro stuff just became, critical for me at that point. And then ultimately kind of ran U.S. sales trading, but it was always about, that macro side. And particularly, during the European crisis, working overnight shift, it was like this whole new world for me, because it was so deeply, fixed income oriented, where a lot of people leaned on the fact that I was up at, midnight, 1 a.m, doing my job, kind of setting the table, because they needed to come in each day and understand why, some, Greek auction or an austerity vote, or what was happening with sovereign spreads, what was happening with crossover, or what was happening with the SX7E or the Italian banks, whatever it was, like why that mattered to them and set the table. And that was my job. My job was to set the table for them as PMs and CIOs and heads of trading started waking up at 5, 6 in the morning. Here is your note. Here's the world. Here's the story, while still embedded within the equities business and kind of, trying to bring a complex story all together.
And did you, when you started writing your letter or your note? I don't know what you call it.
I mean, I don't even know, honestly, in hindsight, when like that, I think it was called like, funny enough, it was called like Big Picture when I was writing it at RBC. I'm guessing it was probably 2011, 2012, something like that. And there was just demand for it. And it was, initially kind of my client list. And I think it started getting forwarded around, and I was live learning, right? I mean, I was trying to get educated with our EGB traders and our FX strategists and other participants in the market that the markets that mattered at that time, trying to understand, our economists trying to understand European creditors and debtors, and that was a big part of my self-education was being reinforced as I wrote that note and shared it out with clients. And I realized that was the model, right? Grow this network of people who have diverse skill sets and diverse thoughts about what is currently happening. You have long only guys or asset allocators with a much different time horizon than a macro hedge fund guy here, or a long short equity guy here, or an asset manager credit guy here, and use that feedback loop to improve the quality of the content, put thoughts out there, distribute it, get thoughts back, refine. And years later, I was sitting in a meeting. I was still at RBC. And I was sitting in a meeting. I was called in to sit down with the head of a big name hedge fund, very famous guy, and like a bunch of his PMs in the room. And about 5 minutes into the meeting, where I think I had made like a big value growth kind of reversal trade call that had come to fruition. And I realized it wasn't about that. I realized I was kind of being interviewed.
Okay.
But at the same time, as I was kind of going through this tribunal, the head guy kind of cut in, and he said, "You know what I'm realizing? You're of more value to me there in your seat than you are if you were sitting here."
Yeah, because you need to have all the contacts in at the bank.
That. That's it. You need to see where the risk is. You need to house the risk and wear it and feel it. You need to see where the bodies are, with the client side interactions. And that was, which is ultimately, how things progressed to Nomura.
Okay, so before we get to Nomura, I just got to kind of laugh about this, and I think you've alluded to this before. Everyone thinks of you as a quant.
Oh my God. Yeah, I know. I often see that referenced. Unfortunately, I want to be the first to say, I am not. I did not study math in Paris. As I said earlier, I was a government major. I wrote vicious papers. I loved research. I loved, second order thinking. So there were some certain overlaps, particularly with like option space or systematic kind of, where volatility is your, exposure toggle and these, kind of larger concepts. But from a risk management perspective, but yes, I'm a qualitative storyteller. And what I realized was that, when I have that top-down view, that macro view, I need to support it with data. I need to surround myself with the best tools possible. And the best tools possible means, quantitatively, not just narrative responding, not just narrative fitting, but quantitatively support your case and support your view. So that was, when I, further, got deeper into the equity factor space, started thinking about things with regards to, not percentage moves, but, standard deviation and distributions and ranking and quintiling, and beginning to, surround myself with people who could, back test stuff to death in Python, right? And get affiliated with, the quantitative investment strategy folks who would build passive strategies, around a lot of these like risk premium ideas. And then, most importantly, for where I am now, move to the place where you can't be automated away. Right. And that was this larger idea of, as the markets kept evolving, I spoke to that before. If you're on like an agency desk in this day and age, if you haven't been automated away, you are going to be automated away. You needed to move to where complexity was. You needed to move to where, this was multi-dimensional spatial thinking, and there required humans, and it required risk taking, and it required a lot of calculation. And that was, the options component of this kind of trajectory or evolution of mine, where I needed to embed myself within that world. One, because I started realizing that those are the flows that matter. In a kind of in the post-crisis world of Volcker and Dodd-Frank, where regulatory risk, regulatory capital, risk management was, forcing a certain type of behavior from the largest dealers in the world that really didn't allow you to be running, Boku short crash or short tails or short gamma, or that then meant a relatively simplistic but very big market impact with regards to how those risks were hedged kind of on a daily basis.
Okay, one second. Can I just interrupt here? Because we're going to get into those things. But before we do, I just want to circle back to your evolution as kind of trader into understanding and being more familiar and actually digging into the numbers. And yes, I understand you're not a quant, but you've adopted the language of the quants and you understand it all, and to be able to tell your story, you've had to make sure that you understand what's happening completely. Could you talk to me about first of all, what was the kind of the hardest part about that, and maybe what was the biggest surprise as you went down that road?
Well, you have to be really modest about what you are. And again, thankfully, I'm so grateful that I had that options training exposure in my first months and years of the business, where I wasn't having to completely recreate myself, and start cold right into this idea of kind of non-linear markets. But you had to sit and learn and ask questions and read books in your spare time, to get up to speed. And then, at the end of the day, you can't teach intellectual curiosity. But, when I'm sitting with a junior or an intern or somebody who's interviewing, those people who say, this is the industry for me. I like this environment. I like this challenge. I like this pace. I like this, dynamic nature of how, especially in this day and age, hilariously, of like zero DTEs, where, like, as I like to say, every day is its own unique ecosystem. You need to, that should motivate you to uncover, the new world. And I've loved that part of, the last 10 years of my career, where, I get to go in my seat where the ball is, go to what's hot. Like, it's not every day that, equities is going to be the most interesting story out there. Oftentimes it's going to be, it's going to be rates, or, it's going to be the vol space. Sometimes it's going to be FX, other times it's going to be commodities, whatever that is. I need to be competent, to be able to speak that language, to be able to interpret that and bring that back into and do my storytelling to make a compelling case or explain what is happening to somebody who is sitting in another world. But right now, that's what matters to the overall kind of macro shape of the market. And that requires intellectual curiosity. That requires a willingness to sit down and rip through books and rip through reading all weekend. And my wife can't stand it how much I'm on my phone reading at all times, but it reinforced a behavior to never stop learning, never stop reading. And I'm just voracious about it. I try to read everything I can.
All right. Okay. So you're there, you're at DS, you're doing this. What makes you eventually make the move? You go off to Nomura.
So that was really about kind of that point that I was making with regards to you gotta see where the risk is. And I had a number of clients that were saying, look, you know, Nomura, the options business there, the equity derivative business there is spectacular, run by some incredibly brilliant people, and they're a secret weapon. A lot of people don't realize what they have, but at the end of the day, for certain kind of regulatory reasons, there's an ability to run a greater risk tolerance, and what that meant, particularly with that equity derivatives business, is, and also too, there was kind of a few other legs of the stool there. The spectacular QIS team there. It was the old Lehman.
What is QIS?
team.
I'm sorry.
Just quantitative investment strategies.
Okay.
QES in some other places, but the difference was about that. And again, this was just such another tool in my kit. Was that so much of the street's QIS stuff is based in equities, and again, like those kind of standard factors. The really cool thing about the Nomura QIS team, and still to this day, much the same folks. It was the old Lehman QIS team, and it was flip side. It was 80-20 and 90-10 fixed income factor strategy. Carry and trend and some really neat stuff across EMFX or European credit or multi-asset or commodities, where you were implementing a lot of those kind of those factors, but in fixed income products. So that was a big part of the skill set that I wanted proximity to. And then the third was that true macro policy side, which you needed to have a great rates business. And the rates business is Nomura. It's just some of the most talented people I've ever worked with. Really bright guys and gals. And the final kind of really neat thing about Nomura is it's really flat. It's a very flat place, so there's not layers of bureaucracy. And it was a perfect place to take up my proximity to, and that kind of osmosis of risk taking. With this seat on this floor where there is risk being taken, and that back to that story of sitting with the guy, the head of the firm, who was kind of interviewing me and realizing where I was. It wasn't just about the risk that we were taking, but then I also too had this network, this diaspora of unique individuals with different time horizons and different product specializations and asset classes, and that mix of client feedback loop plus risk-taking acumen made Nomura, to me, look like a macro hedge fund on the sell side.
All right. Okay, so now I have a question for you in terms of an aha moment, let's call it. I had the aha moment a little late in terms of the idea that changes in a dealer's hedging book can cause, let's just say, market movement. So, like, the market can be affected by changes in the dealer's hedging book. And I'll just tell you when I realized that the Vanna and the Charm and stuff like that. When I was at RBC and we had our book, we understood that on Friday that we were going to approach a weekend, and we put time ahead in our book when we were pricing options. We took out, I can't remember when it was. Let's just say Friday, at lunch, we made it Saturday, something like that.
Yeah.
But the thing is, our books were never big enough. And yes, if I probably looked, I would have realized that, yes, my delta moved a little when I did that and stuff like that. But our books were never big enough that it caused any real change to the market. And then when I was talking to Jem Carson, and he was explaining when he was at, I guess he was at DS2 with us, right? Like with you guys. He worked at RBC and the old O'Connor, was it O'Connor Group? There was a group.
O'Connor was with the UBS.
Who was it then? It was some other option trading group that was there. I can't remember. But Jem Carson said that he was sitting there and he would move it. And then he'd realize that he would have to go do all these trades. And he's like, holy smokes, if I'm doing this, what is everyone else doing? And he had this aha moment where he's like, holy shit, the actual changes in my book vol or whatever it is affecting the market. And so he had his aha moment a lot earlier than mine because he was the one doing it. When did you have your aha moment that the dealers themselves were affecting the markets? Like in essence, the tail began wagging the dog.
That's a really interesting question. I think probably oblivious to it, that first, 8 or so years in my career, kind of the sub 2010s. It was likely then, if you think about the European crisis and me working live overnights, just doing like European cash or whatever, that, in particularly, with regard to, the French banks and their profile within the, derivative space, seeing, some of the stuff that was going on with it, especially as I sat and straddled into the start of the US day, my old business, right? As the US guys would come in, I would see the shape of the day as we went into the midday auction or as we would go into the European close versus the US markets. And I realized I was sitting here and I was be like, no shit, this is why we just ripped 2%, at 11:30, going into noon, or vice versa. And like it was so obvious to me at that moment because I was, conscientiously straddling this world.
Right.
But I also too was seeing these huge, SX7E prints going off, upside or put spreads going off because something was going on in Italy. And then you would just see the market implications of trading out of this risk or hedging this risk. And, then all of a sudden it was like, oh, that is tied to this print. I need, the delta and the Vega impact here to go out with. And the US, people that I was kind of working with at the time, and, there wasn't a huge U.S. equity derivatives business early on when I was doing the European stuff. The cash guys were just like, let's get that color spinning. Like, how can we make this work? How can I get the color on the Greeks impacts? And at that point, it was clear as day that I'd kind of been missing the ball for years, just with regards to that relatively predictable sequencing of how dealers have to hedge these things out, particularly around, liquidity moments or into, ends of day.
Okay. Now, one of the comments that you made was that a lot of these strategies are negatively convex. Could you say, just for those who don't know, could you explain to people what that means, and then give us examples of how those strategies are utilized, and then how you incorporate them into telling your story?
I mean, I think the easiest way that I ever explain this to, somebody in cash, and I just want them to think, I don't want them to think directionally. It's just about buying or selling of optionality. And, so before people start tying themselves up and drawing hockey sticks, or getting the idea, I like to think about things, short optionality or long optionality. Now, in the sense of, negative gamma or negative convexity, that environment leads to enhanced volatility simply because dealers then are short options into a direction. It facilitates and extends or risks overextending a trend, right? Because you end up having to buy into up markets or sell into down markets. This is negative convexity is kind of the equivalent of, short gamma, kind of from nomenclature, parlance, with regards to, particularly used with regards to, mortgages. But it's the exact same thing. Like the lower, the lower the rates go, the more you have to buy to stay hedged.
Right.
Same dynamic. The higher they go, the more you have to sell. Positive net gamma then made sense to me, and that's the prevailing traditional, especially if any of us that came up. I came up, I guess, before the crisis and after the crisis, but for large swaths of the universe out there that came up in the QE era, where it was just outright vol suppression, right? Between negative or zero interest rates pinned, forward guidance pinned in large scale asset purchases that made everything just one big, like, long duration trade and just absolutely cratered volatility. That we came up in a generally speaking, a positive gamma environment that was, it was reinforced the opposite, right? It was a stabilizer. It was a range compressing flow, because we were just kind of like in a grind higher market of Goldilocks. And, central banks, as I like to say, particularly off the example of last year, in the QE era, they're telling you to run leverage long assets. Ironically, in a QE era is when skew is steep, right? The relative kind of demand, let's think of it, of a put versus a call. Why is, if you're in a grinding higher market and you're being told by central banks to be long risk assets for a wealth effect that supports consumption and demand and all those things, why would skew trade at premium or relative premium versus a call? Well, it's because you have an asset to hedge, as opposed to the 2022 FCI tightening period, right? Which was peak QT. Everybody's tightening, rates are getting jacked up. You're introducing risk premium to the market, and central banks are telling you don't be long assets, be long cash. And in that sense, that's why skew flattened to kind of this historical 0 percentile, because meaning relative demand for puts was extremely low on a historical basis versus calls, because it was like this, as a term I've used previously with Volmageddon. It was like a neon swan. You knew that we had to unwind a decade's worth of the everything duration trade. When in the case that we somehow, whatever it took 10 different idiosyncratic factors, but in the case of an inflation impulse, and we got that. So like last year was this controlled demolition. It was this crashless sell-off. And what that meant was, like, I didn't need to grab for hedges because I didn't have any exposure on. If anything, people were grabbing for upside tails because they had no exposure on, and that created this call skew that was like 100 percentile all year. And that still is relatively kind of where we are now. It's more like an 80, 20 percentile type of a thing, and I can get into that later. But this goes back, like skew, like vol regimes and skew regimes change with macro regimes. But at the end of the day, the things that are still going to be persistent are how dealers have to hedge around those flows, however directionally it works. And that positive gamma, is a stabilizing vol compressing dynamic that keeps things in place. It's higher order. It's a tighter distribution of outcomes. A negative gamma regime leads to more underlying volatility because you're feeding into momentum in either direction.
Okay, now you brought up skew, and you brought up the last year of the decline, and the controlled demolition is a great way of explaining it. I think a lot of people were probably surprised that their vol hedge funds didn't do better. Were you?
The thing was, like, Gamma only realized, and I'm psyched that we're talking about this. Gamma only realized on days of CPI.
Yeah, and there it was unbelievable, right?
And you had to trade out of it then, because what ended up happening was, as this was kind of this neon swan and this just controlled demolition and this just grinding degross of longs, and if anything, taking up your shorts, because that's where all your alpha was. It was just so predictably grinding lower. No crash lower, grind lower, crash up, ironically. But what kept happening, especially in like the back half of last year, that was wild. I think we printed like 8 out of 9 CPI upside surprises in a row or something like that, right? Gamma kept realizing on those days. But what started happening towards the back half of last year, as people started doing the math and the recession story started kind of catching, and people were saying, oh, we're going to, over tighten ourselves into an accident. People just kind of jump ahead with regards to the FCI implications of the Fed getting closer to the end game, getting closer to the terminal rate, especially as data began to slow in manufacturing and housing in particular. And when you started getting that, what started happening on these days where, CPI was the input, the Fed told a single mandate. They're dropping the full employment mandate, right? This is just about getting inflation under control. Well, as that started happening, these events where you would get these seemingly very hawkish, very risk-off, asset-off, catalysts, the realization of, oh my God, they're going to have to go 50. Oh my God, they're going to have to go 75. What you would end up getting was that the entire world who had on like legacy downside, or at this point now same day or 1 day till expiration downside, would just come out and monetize the shit out of their downside, and you would get this enormous positive delta impulse. And then to make things worse, and this is again a function of the market structure shifting at the time too, into this short dated expiration universe where we now have an expiration every day, people would further exploit knowing that people are going to monetize their local downside, right? Nothing like deep out of the money, because that stuff wasn't ever monetizing. Deep out of the money stuff was not working and was not hedging anything. You'd monetize that like local stuff, and we'd start ripping higher as you started getting calls, started getting melted, and we start ripping higher, and then people would begin buying same day calls to exploit that snapback and positive delta. So like a number of those CPI days are like hawkish Fed or ECB messaging, rhetoric. We would actually trade higher by end of day after a seeming gap down, open lower. It just happened time and time again, which one, it speaks to the new market structure. It speaks to the velocity of these moves, and it speaks to kind of the change in muscle memory, which was here's the realization of your event. You need to go monetize and turn the other way because of these reflexive systematic forces at play, these reflexive, forced regulatory risk management forces at play, with regards to, how dealers are going to have to hedge out of their risks or their exposures and, completely turn the boat around. The number of times I would get from like a traditional equity guy last year, like, how in the world could we trade higher today? Our terminal rates just jumped, 30 bips in a day, terminal rate projections that just goes back to this idea that, if you're not, keeping an eye on, the real tail wag the dog flow, options and derivatives, hedging, you don't have the full story.
Okay, Charlie, you brought up a great point there in terms of the tail wagging the dog, and the option flow influencing the underlying market. A lot of people are kind of confused, or not, maybe confused, not the right word, wondering if the huge amount of flow in 0-day options is increasingly causing a destabilizing effect or a stabilizing effect, and who's doing it and why. And I'd love to hear your thoughts on this topic.
Yeah, it's obviously it's funny because for the seeming revolution of the past whatever 6 to 8 years with regards to the idea of dealer Greeks and dealer hedging, and the famous charts on kind of where gamma versus spot, and short downside, long upside from overriders and all those assumptions. It's almost rendered those old things that used to be so provocative now irrelevant. And it's that point that I made earlier about like each day is its own ecosystem now. Like, it impact. We're talking like autocorrelation. We're talking about trend, momentum, and all these dynamics. But like, there is no reason. If I knew what, we've said this recently in a bunch of months, if I knew what the next CPI number was or something like that, like for the last 6 months, you did not know how the market was going to respond to it. For some of those reasons that we just talked about. And I'm sure that you felt that too.
100%.
Like, if I had that information, that data leaked. I was looking, and so with these flows, I think we now realize that they are kind of the boss, and there is incredible potential, especially like the recency bias with these flows and what we experience kind of in the peak of the speculative frenzy and the YOLOing and the meme stocks and things like that. I think there's a conception that look, most of this flow ends up being about bought deep out of the money stuff to try to create quote unquote gamma squeezes, right? To try to weaponize gamma. And that is true in certain circumstances, absolutely. I think the more nuanced story for me, and look, and everybody's really trying to figure out, like, how do I measure this in a way that's more than just looking at volumes and open interest? What it comes down to is you need to be able to see, and this kind of feeds back into some of those, like the bastardization of some like the OCC charts that, like, oh my God, look at the amount of puts out there or whatever. Or look at the volume of puts traded. Like, it's about puts bought to open, puts bought to close, puts sold to open, puts sold to close. Like, you need to get a sense of the netting.
Yeah.
And to me, the way that we're cutting this up now, in real time, we're trying to look at trade pressure, right? Which, is telling, and it's hard because in the index space, as competitive as it is, and it's still relatively liquid as it is relative to so many other asset classes or means of like macro hedging, a lot of stuff trades at mids. And there's clear like multi-legged structures. There's condors and spreads trading all over the place. And what's tied? What is, I sold this to buy this. It gets complicated, with regard to assumptions. The trade pressure matters, because if something is, is trading bid side or offer side, I have a sense for, it being bought or sold. And that to me then, so the story then to me isn't about just looking at the uptick in volumes and DTEs and necessarily assuming that this is about, quote unquote, retail YOLOing. To me, I think part of that retail discussion about anything, people just look at generically at like lot size. But like lot size doesn't mean that that's just retail. Lot size to me means that stuff is getting sliced and diced in the algo chipper like I used to be dotting 100 share lots. You know what I mean? So like that to me is like a false narrative that this is all entirely, being driven from, retail, the kind of the cumulative meta impact of retail investors, where, more than likely, especially the proliferation of retail has had a huge impact on it for sure. But then it's the people who are kind of on the other side of that electronic options market making side who are the savviest with regard to risk management and their algorithms and shaping their books, who are doing a lot of this pinging back and forth to manage those risks.
Yeah.
And that's that idea of like, it's dealers and market makers are a huge part of this story and a huge part of the volume story. So I need to isolate customer flow in the 0 to 1 DT. That's the first starting point with like, particularly with like the index, SIBO data and like index side.
One of the things though that I would agree with you in that there's more than just a retail story here is because one of the most popular 0 DTE option is the SPX, like the big one.
Yeah.
Well, and like I don't think that there's retail tossing around big, 0-day SPX options. So I'm kind of confused about that. And I'm like, who's trading these things and why? And I'm trying to understand it. Do you have any insights in terms of that contract specifically?
Yeah. Well, so look, there are, when you're hedging, you're going to hedge like anything that's a lookalike, so, SPX, SPY, if, you can, from an institutional perspective, you don't need to stray too far from your home base and, trading in futures or trading in, big stuff. If you look at like SPY percentage of overall options volume that trades 0 or 1 DTE, you're talking like on average, and I'm just looking at our numbers. So like so far today, SPY, makes sense, retail-ish, 68% of the overall options volume today is 0-1 DTE.
Really?
Right? SPX is still massive, but so far today it's 55%. Those are both kind of sort of in line with where they've been over the last, kind of over the last few months with regards to their average. But SPY, if you then like chart like the SPX, the shape of all the growth of all the kind of the bucketed different expirations, SPX is stalled out there. SPY keeps going higher. So like it's popular. People are still doing it and doing more of it. And obviously SPY is a more retail day trader driven vehicle. So like it's absolutely a part of the story and part of the backdrop. But for the shapers of that risk, they're still going to go into the big stuff, the big, most cost effective stuff. It's going to have an impact in SPX. And that's the other thing too. Like, people will try to push back on, some of the Greek analysis and say, well, what about OTC trades and this and that? But like, it ends up kind of recycling out into the listed market anyways.
Oh, yes.
Right.
Yeah.
So I think a lot of these things, you're getting a general shape, you're getting a 2/3 of the overall distribution, and it gives you direction, right? It's not the only thing that you can base your views on, but if I'm seeing I'm looking at the moneyness distribution of the 0-1 DTE stuff over the course of the day, and I'm seeing that in the 101 to 103 bucket that it's a net imbalance to sell in calls. That tells me like overriders are pretty active. That's a very different type of a mentality from a kind of a speculative froth perspective than a day where that's a huge imbalance to the buy side, which is telling me that people are YOLOing, and vice versa, same thing. Like especially like the most highly speculative of them all is if I see like an imbalance in one of the kind of the wingier buckets, or the deeper out of the money stuff, if people are selling puts, that's telling me we're pretty much like near peak froth, peak foam, peak speculative, right? In this environment, just goes to show you how much the regime has changed from that FCI tightening, sell assets, be short assets trade of last year to now this current immaculate disinflation. And what does that mean? That means that relative to where we were on terminal rates just a few months ago, that the above faster than expected disinflation that we're seeing means past peak inflation, means past peak Fed, means a lower terminal rate, and that is a de facto rate cut. So you're getting components out there right now from a behavior perspective. You're seeing a big resumption in vol selling strategies again. And that's going to tie back into whether people are not are overriding and underwriting, whether or not people are doing VIX futures roll down again, and that's going to feed back into the behavior of meme stocks, to the behavior of high yield. All of those things are tied into kind of the same temperature taking. And at the end of the day, Kevin, like that's the way that I view my job, is that I'm like a blind spot monitor. For somebody who's long only, or like is an insurance company managing a fixed income book, and we think that we've stabilized from an inflation perspective, and rates and treasuries and duration is rallying, and and we're getting some data points that we're actually FCI is really getting loose here. We're seeing the impact that it just had, for instance, today on pending home sales, where a 30-year mortgage rate has backed up 90 bips in a short period of time, and there's so much supply-demand imbalance with regards to the housing market, that all of a sudden old homes are clearing, and people are lining back up for showings again, and the FCI easing and the wealth impact of all that stuff. Well, that insurance manager, and I'm seeing it in people selling puts again, and I'm seeing it in people selling optionality. Like, he's going to want to know that, well, shit. Like next week into the Fed, there's probably a mispriced risk that Jerome Powell has to come out a little more hawkish than the market's anticipating, because FCI has loosened too much too early, and you're getting a wealth effect, and break evens are widening and commodities are rallying at the same time. So like all of these things tie into a story, and it's never linear. It's not about absolute levels. It's about rates of change. It's about change of change. Like that's the way that my mind shifted, moving from like the cash world to kind of the derivatives and the macro world. You just got to think about the move ahead, if this then this.
All right. So now, one of the things that I've experienced, and I wonder if you had the similar experiences, that when you talk about different asset classes and different types of traders, I had numerous times last year where Powell would come out and do something, whether it be 50 or 75, and he would talk about something, and I would look at the front end of the curve or the whole curve, and it would barely move. And the fixed income people were like, okay, exactly like we thought. And then meanwhile, the equity guys would be losing their shit one way or another, right? And
Right.
there seems to be a big disconnect there. I was wondering, do you find the same thing in terms of the equity group's inability to understand the Fed, and do you think there's opportunities there in the fact that there is that, if you do believe there's a disconnect there?
I don't think I've never appreciated the the conversation or the classification or the misdiagnosis in my mind of this idea that equities guys in and of themselves are dumb versus fixed income guys. There's yes, there's a bond math is different. But as it relates to having simultaneously different views on things, like sure, like you're allowed to do that. I think it's overstated.
Oh, you do.
When you hear it a lot where people are like, what do bonds know that equities don't? Well, like first of all, like correlation shift, right? That was a huge part of what last year was, where duration drove everything for over a decade because of the QE era and NERP and ZERP, and when that switched, all of those strategies and all of that recency bias and survivorship bias that created in duration assets meant that you were dust last year. Whether that's 60-40 or risk parity or a private equity fund which is just engorged on shitco unicorns, VC, or like a TMT fund, right? I mean, or a growth manager. It was all the same trade because you owned long bonds basically. But guess what? You get the slowdown hitting, and you get the light at the end of the tunnel that the tightening is over. And if the slowdown hits, violently enough, you're going to get the unwind of QT at the same time you get your first cut, or the cessation of QT certainly at the very least. All of those things completely flip that bond stock correlation. And the world isn't just bond stock correlation, but you get the joke there. There's going to be times where yields and stocks should look a lot alike, and there's going to be a lot of times where yields and stocks should be telling very different stories. And that's about kind of the economic cycle. Is growth up and inflation is going lower, and inflation isn't just going lower, but it's going to a more stable place, then stocks should probably be in a really great spot right there, in that part of the quadrant. There's growth down, inflation down. That is that more contractionary kind of pre-recession phase where you're probably going to have a little bit of a different flavor, certainly thematically, right? When you're going to be in kind of more traditional defensive low vol type of stuff, kind of like the Q4 or second half last year price action. But then now, hilariously, what you're seeing is all the highly leveraged, low quality, unprofitable stuff leading the charge, because all the stuff that people were short last year and drove all their alpha is now having to be force covered because you got to take your nets up. Because
is that what you think is happening? Because I was wondering if you think that's what's happening.
Yeah, I mean, that's the first phase of it. I mean, the bigger deal is with regards to what's happening right now. There's an obvious underpositioning dynamic for
right.
What we've already discussed with regards to kind of the QT mentality. I think a lot of people thought, and I spoke about this in the last few notes. I think a lot of folks thought today, or in the last few months, this kind of had this mentality. The consensus was going into the start of the year that the first half of the year was going to see this hard recession, hard landing. You were going to get that that earnings recession that drove some of those kind of doomsday type of S&P target scenarios. And then the back half of the year, then you're going to trough. And then the back half of the year, you're going to get that deep enough slowdown where the Fed is able to kind of pivot into an easier stance. You had 50 bips of cuts priced into M3, Z3. And away we go, and equities recover. I actually think it's kind of the opposite footing, not necessarily on an H1, H2 basis, but that you actually have a really kind of awkward dynamic instead, where the three big stories of like global growth drag and tightening last year have all kind of flipped on their heads. Right? In the U.S., that big FCI tightening that we've withstood, that was kind of that short assets trade, is late stages, seemingly, as it stands right now. Above, the kind of accelerated disinflation, it's getting a little bit of meat on the bone now too, because you've begun seeing, some of the subcomponents of, or even second tier data outside of like NFP. You've been seeing, some jobs components, some hours worked components, things like that. That are showing you that labor, private employment, things like that, they're showing you that labor is cooling, and that wages too are off the boil. That lends a little bit more credibility and supports the Fed story more than this, and helps you get to a better place. the other two big drivers of like the dollar squeeze last year, of that dollar wrecking ball, besides just the Fed hiking and behind the curve, catching up on having to tighten financial conditions, was of course the European recession story, which was a certainty due to the energy crisis. Well, guess what? They got their inventories up by jacking the rest of the world's nat gas and paying through the nose for it. And in the meantime, they had a mild winter, and gas prices, which were more reflective of like, they look like CDS, right? They're more reflective of like hedging pressure, of obligatory hedging pressure, than they were of actual like future views on prices. They've just absolutely melted. And that story has reversed. And now everybody's ratcheting up their European growth data. And then the third, of course, being China zero COVID. Everybody in the universe thought that was a spring unwind story. Well, guess what? Like, the pressure got so bad and the demonstrations got so bad that Xi bent the knee. And in, kind of like late October into November, bang, switcheroo come December, and everybody's caught dead flat. So those $3 upside stories that were like the driver, the core of dollar strength last year, was the peak input of FCI tightening, financial conditions tightening, have reversed. And as that reversed now into this place where global growth is much less bad than we thought, and then you add in the subcomponents of what U.S. economy is doing, right? And I mean, think about what the U.S. economy is doing right now. It's pretty remarkable. You've just in the last week, we're talking about durable goods and jobless claims beats again, right? Labor is still so strong. Wages are still sticky higher, even though they're off and then nominal GDP is like 7 or 8%. Today, because of the FCI easing that you've seen recently, and, mortgage rates pulling back, whatever, like, you had the pending home sales beat too. So housing is stabilizing. Housing and housing and manufacturing are where like the recession is already hit in the United States, but now that stuff is getting better. So like everybody had priced in worst case left tail scenarios hard last year.
Right.
And now that that's not happening, now that actually U.S. services is a service-led economy, manufacturing is still, kind of 1/3 of it, and it's rough, but housing is not as bad as projected. And labor and wages are where they are. Like, that's kind of offsetting some of this drag, and the rest of the world is better. Now that first half of the year, that first part of the year, is a much more stable growth environment. People are getting caught flat-footed because they were under risk, thinking there was a hard landing recession happening imminently. And what is going on is this massive asset allocation trade. So like I highlighted in the note today, in global equities this week, there's a 92nd percentile back to like 2000 inflow. In global bonds, 93rd percentile inflow, $12 billion. In global credit, global IG credit, 92nd percentile 1 week inflow. In money markets, which took in $222 billion in the past 1 year because cash had a return, cash was an alternative, cash was an asset class again, actually saw an outflow for like the first time in eons. So people were wrong-sided because they had the wrong sequencing in their mind.
Right.
They had the wrong sequencing, thinking we were lower first half, recover second half. I think it's going to look a little bit like different because you're actually better than we thought right now. The pain comes later.
And any signs that position correction is close to being finished, or do you think it still might have more room in terms of squeezing folks more?
Yeah. I mean, I like to, I'm all about, positioning and sentiment and extremes and finding where the asymmetries are, particularly on the systematic stuff, because generally speaking, right, the whole idea is rules-based. It's unemotional. And those flows you can, model out pretty well. So, we have seen, for instance, with, last year, the CTA trend, space, had a historic year. It's because it's not dependent on that bond stock correlation, right? It's been a prolific tail hedge because they can make money in down markets as well as up markets, right? Had kind of a generic finger in the air 30% year by being long dollar and being, short assets basically. Well, CTA, in our model has flipped long across all 12 of 13 global equities. Long signal doesn't mean position max long, but that part has moved early, right? We got a little close to triggering some like deleveraging the other day, but like that percentile rank though with regards to kind of where trend momentum systematic investors are in the global equities allocation is still just like 52nd percentile. If you still look at hedge fund PB data, grosses have been taken way back up, right? Because the vol compression. So vol compression lets you grow, both your longs, re-leverage, but also too, I think in light of the rally that we've seen, people have started trying to lay some shorts back out there too. So grosses are up, but nets are still very historically low. Across a lot of different metrics, as much as I love the short dollar trade, and that's like, meaning kind of rest of world, whether that's, long, A shares, or whether that's, long yen versus short dollar, or whether that's paying in 2-year yuan rates. That, as much as I like that trade, most people really have just taken off the long dollar. You're not beaucoup short dollar yet. So there a lot of these trades, and you got to think about it like asset allocators. We've been in a decade plus of the US exceptionalism trade because we were a levered version of QE, because we are a tech-led public equity market, because of the private equity market was a lot of those same type of growth companies, because all of those things look like a bond. Well, that U.S. exceptionalism trade, and I always called it like we're the cleanest dirty shirt. Every time Europe's got a crisis, it's existential, right? China is a boom bust cycle, and Japan was stuck in secular disinflation for decades. So like it was kind of lack of alternatives. Well, now you have some pretty interesting alternatives, and at least as the dollar is pulling back right now and resetting, it's like down 11% in 4 months. It's a no-brainer that from an asset allocator perspective, that you've got to resize your long U.S. exposure. So just think about it like capital flows with regards to the dollar alone, or with regards to other currency alternatives, long yen, long euro, long yuan. So like all of those things are still very much intact for me. Like I think that those trades matter, and those trades, when you're turning the Titanic, a couple of $billion a week in a still a market where a lot of people have been sized down or still just kind of trickling back into the water, is going to matter in those flows. If you're talking about, again, asset allocator level flows that are, you're really adjusting your portfolio, they take time. So, to me, the bigger move is just, it's like buy every semblance of dip across assets, because you've just depositioned for, not just in assets last year, but in the case of some of these emerging markets or rest of world DM economies, you've depositioned in them for a decade. So I think that those types of trades make the most sense, especially in places where they are, kind of easing. In the case of, still in the case of Japan, or in the case of, of China, like people feel confident there versus a much hazier outlook, for the U.S. for a lot of kind of, lagged inputs and tightening still having yet to play out fully, in the earnings cycle that everybody wants to, be the next leg down for equities, but it's been a challenge to get to.
Charlie, it's a pleasure having you on, and we could go on forever, but I know your dog needs a walk. You have some skiing to do this weekend.
Yes.
Let's go with our final questions here that I like to ask all of our guests. We'll start with your favorite investment book.
So, as I explained to you, with kind of at the start of this, when I kind of became an ambulance chaser. I became fascinated with these kind of crises and crashes, and then like I wanted to know, like, the stress and the shock of all these things was completely fascinating to me. It was like, it was like rubbernecking a car accident, and so it was about kind of recent history for me. I mean, the 3 books that I've loved that I've largely lived through. 2 of them, as I mentioned earlier, but When Genius Failed, for sure. Just, that LTCM story is such a reminder of a lot of things that happen in this business, whether it's, leverage or fat tails or hubris or any of those things. It's a brilliant story. It was cool because I was seeing a client in their offices last week, in their original offices that are still up there in Greenwich. And, you can't lose from that story. It reads like fiction, right? Because it's such a fascinating
it's a great
story.
book.
And then
it's a terrific.
And then too, the other 2 that I would just mention are the quants, which goes over that summer of 07 scenario, plus kind of the hierarchy of a lot of those, the big funds and some of the, the great thinkers in that space, where they've come from. And then, finally just kind of the history of the GFC, which was, too big to fail. I thought that was such a spectacular book, because again, I just, living it on a daily basis and coming in, the prolonged volatility that we went through in that period is something that, folks in the last 10 years just have no idea about. It makes last year look like a cakewalk, with regards to the persistent swings and the persistent shocks that period had. And I thought that story just does such a great job telling it.
All right. So Byron Wien used to do his top surprises for next year, and he defined a surprise as something the market expected less than 1/3 chance of occurring, but he thought that had a greater than 50-50 chance of happening for the next year. Do you have a Byron Wien surprise for us?
So, that's a good one. I can't. And this is funny because everybody says like the 40% probability is such a chicken shit, meaning.
Oh yeah.
Right?
Brent Donnelly talks about that. It's a great line.
Absolutely awesome, right? So like,
oh no, not Brent Donnelly, Dario Perkins. I got it wrong. Sorry, it's Dario Perkins.
Yeah, absolutely spectacular call, because it is incredibly accurate. I mean, you see that number pop up on like everybody's distribution. Yeah. But I would call this more of a mispriced risk, let's say.
Okay.
Which is, look, we spoke about this earlier, and although we've taken out a pretty real number of these supposed cuts built in to the end of the year, but like, at least to me, I think, Z3 puts make some sense in your back book. I know some people are, putting on like M3, Z3 steepeners or things like that, but with the idea,
you're talking SOFR right now, right?
So with the with the idea that we can't get to those cuts that are currently priced into the market, and so as it relates to Byron Wien, like, I think I would start then. What's the worst case scenario that you could imagine? Where we think right now that it's the Fed is 2 more 25s and done. That's priced into the market still. It's kind of wobbled around, but recent data stability, trajecting into actually upside surprises, is a real thing right now. I think, frankly, there's a lot of pressure for Jerome Powell to get a little more, dare I say, hawkish next week than I think he anticipated even a week ago, just because of the risk of animal spirits right now and what's been going on with markets and what's been going on with housing again and things like that. But imagine a story where we think that the Fed is going to be done and even pricing in cuts next year. And instead, because of the ahead of schedule disinflation and all that, feel good, but then the disinflation stalls out. And because growth is better than expected globally, China reopening, commodities kind of beginning to perform again, break evens actually, widening off the lows, that, God forbid, you have a situation where after a pause, the Fed has to hike again. It would be an absolute shit show. And to me, because people are done. I mean, that is part of the re-risking thesis right now. Like, we're over that.
That's why stocks are rallying as well.
100%.
Because everyone's assuming that that's what's going to happen. And he might go back. Like, we might not even get a pause. Well, like, there's a chance that he just goes. He takes the Bernanke / Greenspan playbook of what was it, 04 to 07 or whatever, where they just go 25 a meeting.
They
for a long time.
There is precedent for sure, and a really good friend and a great macro thinker of mine, said this last week when I was talking about, the potential for, rates to go even higher again after everybody's kind of put on this reversal trade, and he was like, what's it going to take in that scenario to get that to happen, as far as like actually pricing in another hike versus the likelihood that we're just going to keep bleeding into the eventual cuts. And that's a fair point. I just think right now, nobody had anticipated, clearly, as the market is telling you, this growth stabilization globally and how quickly it happened and how all three forces aligned at the same time. And when you're talking about in the span of a couple of weeks, as I said, you're seeing 200 bips tighter in high yield spreads. You're talking 90 bips, lower in 30-year jumbo mortgage. And you're seeing reacceleration in housing data. And, as I, just mentioned too, like you just got durable goods and jobless claims still beating, and nominal GDP is at 7 or 8%. Like if housing restabilizes and that kicks off animal spirits and a wealth effect back into the market, all of the good work that you've done with regards to trying to lean into demand side inflation is very much at risk. And then that whole like ghost of Arthur Burns, situation starts coming up again. So like, I just think it is the velocity of this FCI easing into the recent data beats has changed the calculus on Powell next week.
That's a great way of articulating.
Yeah.
That is awesome. Yeah, no, that you're absolutely right. All right, now let's go to the next question, which is there's something called "Damn, I wish I wrote that." That one of the DJs up here in Toronto likes to do, and he's a former rock star that has become an afternoon disc jockey. And what he would do is he'd pick some song, tell a little story about it, play his guitar, and then say, "Damn, I wish I had written that." I like to say, "Damn, I wish I had traded that." Do you have any great trades that you've seen over your career that you're like, oh, damn, I really wish I had put that on?
Well, I mean, I saw it real time, honest to God, I think 3 weeks after I started Nomura. But I wasn't the lucky beneficiary of the P&L, but I got to watch it firsthand. And it was, that my famous Neon Swan story, right? It was knowing and identifying that the rebalancing requirements of the leveraged VIX ETNs would one day be existential and break them. And that was, that they simply couldn't survive that end of day rebalancing requirement into whatever that vol catalyst would be. And then seeing, kind of people identify that early that day after a month of vol up, spot up in the month of January 2018. Right? It was just the December prior where everybody thought that the Trump tax plan was left for dead. You'd price that out of existence. We were already running above trend growth and above trend inflation for the first time in forever, right? This was during the Goldilocks era. Then you got kind of like a shock breakthrough on the tax deal getting done when we were already running above trend growth and above trend inflation. And over that month of January, we started seeing like a bunch of like prices paid beats. Over the course of the month, big upside surprises, like kind of indicating that, there was actual price pressure, actual inflation upside going on. And then I think it was the Friday before, I want to say, or the Thursday before, where there was a PCE or a CPI print, the Friday before Volmageddon, that is, we got a big upside surprise there, like a multiple standard deviation upside surprise. So like that spot up vol up over the month of January when people were grabbing into upside was also a signal that we were not ready, was also a rate signal that we were not ready for a world where we no longer had visibility on the Fed keeping rates pinned and running above trend growth, above trend inflation, then hitting you with this massive fiscal stimulus plan that was left for dead just weeks before. That set the table where we had a Friday sell-off or whenever it was, the week preceding. And then Monday we came in and it hit the fan. And knowing that those ETNs couldn't match what was happening in the VIX complex and that people then began to shoot against them was, something I'll never forget. And just watching the price movements that day when it became kind of a known thing that those guys were going out of business was, it was both horrifying and, beyond enthralling.
Okay, I got two last questions for you, and I'm going to stick them together because I was talking to my subscribers asking if you had any questions, and there's one that was too good that I can't not include. So that question is, we'll start this again. Would be interesting to hear Charlie's beard routine, and then finally, what advice you'd give to a young person starting in the business today?
Man, I'm embarrassed. I don't have like oils. I do put in to be fair, I put in like a conditioner like once a week or something like that, but it just goes, it's a mess. I don't have anybody shape it. I take
You're
my
just natural. It's just natural.
I take my
greatness.
hair clippers. I take my hair clippers to it and like try to smooth it every once in a while before a meeting so I don't look like the full Unabomber, but like it is what it is at this point. And luckily I started growing it on my garden leave before COVID happened. COVID and work from home, socialized this, Brooklyn bartender look. So like, I'm pretty much able to get away with this and people don't even flinch anymore. So that's the first part. Look, as far as, a young person in the business, um, you know, as I said earlier, like, you can't teach it, but if you're already gravitating into this, this area of markets for a reason, it's in you. You're probably, and as competitive as it is to get a seat in this kind of world these days, intellectual curiosity, that "thank you, sir, may I have another" mentality, that, when you have a seat and you're on a desk, or you're interning, or you're a junior, where you just ask to do the dirty work. How can I help you? I don't want to be chirping in your ear, distracting you all day. I don't want to be, bothering you, keeping you, senior, trader or senior salesperson, from doing your job. But how can I help you? Like, let me run some of your shitty stuff, right? That kind of stuff. And you were hired from this incredibly competitive backdrop for a reason. It breaks my heart how many, like, people write me on, like, LinkedIn and stuff, which I check every couple of months, I feel like, asking for, like, a foot in the door. But these people are so talented. The resumes I see when we're hiring, for somebody in our group, are spectacular. I wouldn't stand a chance in this day and age, with regards to the coding and the computational, the quantitative skill set, and, the investment clubs and the side interests, and the, accreditations that people have achieved already in college. It's spectacular. My point being that if you were selected, you are an absolute stud. And you have to believe that you're capable of learning the source material. So don't be intimidated when you get into the vol space. Don't be intimidated when you get into, something, that's, as I said, nonlinear. Like, particularly, being that those are the places that are going to survive the perpetual automation of this industry. And it's not just Chat GPT, right? But, you need to go to the ball, and the ball is in places where you're going to do modeling and coding, and understand risk and take risk, and be able to build a thesis around it and test it. And so those are the skill sets that you need, right? Whether it's poker playing as part of that skill set, or whether that's, Python. So, those are the things that I would say. And finally, just be a voracious reader. As I said, FinTwit and Wall Street Journal, FT, Bloomberg, Zero Hedge, whatever research you can get your hands on, just, like, you've got to have a view. You should be able to elevator pitch anybody about the market right now. And that's where you want to get to. This is my view. Make it about, the impact of policy and rates on equities valuations, and tie that into, a capital structure preference. Why I think credit is more attractive, because I'm able to pick up a little bit more yield, but I still, in the business cycle we are here. Those types of things. I know that's a big ask, but, through educating yourself and reading that stuff, and just immersing yourself in it, you're going to be able to do something that I still think a surprising number of salespeople on the sell side don't do, where they've been trained to push product. They've been trained to kind of push their internal resources, but they themselves might still not have a view themselves, and that's really important, I think, going forward in this business. Clients want to lean into people who help make them look smart, who help inform them, who help them answer their boss's question before it's asked.
Well, that's some great advice. And for those that are interested, and as we said, unfortunately, Charlie doesn't deal with retail, but if you are an institutional client and you want to get his letter, reach out to Charlie and become a client of Nomura. Charlie, listen, it's been a real pleasure getting to know you and chatting with you on it. We really appreciate it. I guess, you're not even on Twitter, are you? Are you?
I'm not.
You're not. You're good. You're like, you have nothing to plug. You're just a nice guy coming on the show with nothing to plug.
I tell you what. I mean, if I were, I would be, in it too deep all day. I already said my wife, like, can't stand me, like, reading stuff on my phone. I would be dead to rights on Twitter. So, and I probably wouldn't do my day job particularly well either with the distraction. So, yeah, for the institutional clients and guys that pay Nomura on the market side, you know where to find me. What I always say about the note, it's the conversation piece. It starts the topic. I get the feedback from different people from different parts of the universe with different risk tolerances, and it helps inform the next piece. And we go from there. You have the conversations, you have the idea dinners, you have the meetings, and it's a really neat process. So always good to have more thoughtful people involved.
That's great. Well, thanks again, Charlie. Have a great weekend.
Cheers, Kevin. Thanks, man.
All right, Patrick, time for talking charts.
Well, I'm going to keep today nice and tight because we seem to be already running quite the show here. So let's just quickly go through. 2 weeks ago, we were talking about global equities, which continue to generally outperform. We talked about the earnings season, which interestingly, what did you take away from this earnings cycle?
It's a little over the map. I think it's not as disappointing as people thought. More importantly is the reaction to the earnings. It seems to be Microsoft shit the bed, but then next day it's up.
Yeah,
I don't know.
It's just the market's just not ready to sell. So the bad news is being bought on dip, and that's sort of the prevailing thing. We'll talk about some of that on the charts right now. And of course, number one, we were watching that Bank of Japan,
which was a dud. They passed, which I didn't expect. I wasn't one to say that they were going to abandon it. It's giving you another shot to sell.
Yeah.
I have a crew in my macro tourist, the group that are kind of in with me on the trade, and we were reloading kind of 147-ish, and it seems to be working so far.
All right, so let's get to the top 3 things to watch over the next 2 weeks, right? And because that's in the next episode, so we're going to put that together. So number 3, are you shocked?
No, dollar index.
Yes,
I am shocked. I'm shocked it's not number 1.
Well, there you go. But you know what? The reason we're going to talk about number 2 and number 1, which has to do with it. But this has been a completely dominant downtrend. There hasn't even been a meaningful bounce or reaction, even a sign that the bulls are trying to get the dollar back. And so it's been bleeding. But we're getting to a stage where the sentiment is decisively shifting bearish the dollar. And even I saw our good friend Ronnie posted a tweet out there showing just how the option positioning in the dollar index is back to 2020 levels in terms of bearishness. The point
you mean
is
my one from my stuff, which he always very kindly credits me.
Okay, there you go.
You didn't even notice. You didn't even notice.
No, I wouldn't have noticed.
You're right.
Did he snag it from you?
Yeah, and he always very nicely credits me because let's face it.
Cute.
I'm stealing it from someone else.
I got your content from Ronnie. That's awesome. All right.
This is like venereal diseases. We just pass them around. So, Patrick, I want to talk about the dollar a little bit because I think you're going to be wrong. And do you know why I think you're going to be wrong?
Well, what do you mean? What call did I make?
Well, because you're saying
watching it.
You're watching it. I know you. You want to buy
All
it.
I'm saying is that in such an oversold situation, not buy, but I think that we have obviously central banks. We're going to talk about that all coming up. I'm just wondering whether something offers a spark that creates a short squeeze, the counter trend. So now you disagree with that. Go ahead.
So I'm telling you why I disagree. That think you might be wrong, and that most likely the dollar will keep going. It's because because I also agree with you.
Oh,
like I am worried about it. I think
but did you take the position on in size yet?
Well, no, but I took. So listen, you know me. I never go long the U.S. dollar. It's just kind of not something that's in my DNA.
Yeah, I mean, my
I'm flat.
is predominantly U.S. dollar based, so in itself, it's a tailwind without having to take a position, right?
So I'm flat or flat-ish. I've been going that way. So it's about to the sell-off's about to accelerate. That's all I can say.
Okay. All right. So quickly, we'll do number 2, which is the jobs numbers coming out on Friday. But I'll combine number 2 and 1 because I think overall it's a big news week because next week is the big news week. The week after, there's again almost no news. So there's this, it's the pig in the python. I used the wrong thing last time, but it's this idea where literally starting on Wednesday will be the FOMC. Then first thing in the morning on Thursday will be Bank of England and then the ECB an hour after them or 2 hours after them. And so the 3 central banks all within less than 24 hours apart. And then comes the jobs numbers the day after.
Oh. It's like 3 days in a row of just like big events.
But
by the way, what did you
within
use?
48 hours of
Right.
So there's this one moment where we're about to get, we've been almost no news for the last 2 weeks, and we're going to have no news in the week after. And so this is sort of this moment where if there was going to be a new trend emergent from the markets driven by some sort of new reaction to some data points, it's we got to watch next week. The next week's that moment, right?
I have a question for you.
Mm-hmm.
What did you say instead of pig in the python? What did you get wrong?
Oh, it was the golf ball in the garden hose, and then I realized that was from what was that that military movie?
It's something that's not.
It's not appropriate.
But you know what? It's kind of
someone who is capable of pushing.
Yes, exactly. No, it's not pushing.
Pulling.
Patrick, you got to get your if you're gonna use.
I'm so horrible at this.
Andre, you gotta like use it properly.
Oh my
God. Okay, so let's get to the charts. What do you got going?
All right. So anyway, by the way, do you have anything to comment in terms of what you're thinking?
No, I think that you've highlighted the fact that there is those 3 days will mean a lot. It's great.
Yeah, but is there something you're expecting from the Fed?
So I wasn't previously expecting anything. A little part of me thinks that the rally in risk assets has accelerated faster than I think that most people expected. And Charlie talked about this, and I'm sympathetic to the view that at the very least they might push back against it. I don't think they're going to change their policy, but I think that they might say something to the fact that they're watching it and that it's
just like just a little bit of a hawkish kind of tilt in the language.
So it's probably like
it's
a hawkish 25 is probably, if I had to guess, that's what comes out.
So
because let's face it, the economy is stronger than everyone expects. Or expected.
So look at so I just want to highlight that I don't think what happened since the start of January is that extraordinary. Like, okay, so this rally since the start of January on the S&P has been about an 8% advance off of that low in late December. I'm just picking the low print, so trough to peak. But if you look at the two separate bull impulses that happened in October and then again in November, that off the lows, that October impulse was 12%. And the November impulse was also 11%. I mean, this rally, while it's been 8% and it's been certainly advancing higher, this is not exactly like some new accelerated bull push that is going parabolic. It's just the market is advancing in what is the pain trade. And one of the things I was talking with my members over the entire month is that like rarely does a market crash when everyone expects it. So what is the pain trade? And that's the market crawling higher, just causing a lot of pain. And it's when everybody is so confused at what's going on is when the risk is always the greatest. And
I think that's great insight, Patrick. And I completely agree when you said the pain trade, but I'll take it one step further. And I'll say that the pain trade is short all the shitty, like the Goldman Sachs unprofitable tech index, which you can substitute ARK for it. And it's in essence follows ARK. So let's go look at ARK and you say, yeah, this isn't that big a deal. But if you're short these things, all of a sudden ARK has gone, what's that on a percentage?
25%.
25%.
30 or 30%, something like that. Let's see.
It's rallied in your face hard.
35%, yeah.
And I think that's why it feels worse than it is, because everyone's short the wrong stuff. Me included. Listen, I got it on too. So it's not like I'm not feeling this. But I think that's why there's kind of a little bit of panic, let's just say, with the shorts, because it was so easy to be short all this crap. And now all of a sudden we got a rally, and it's a big percentage gain. And you're just sitting there, you're short ARK, you're short Tesla, you're short whatever, Goldman Sachs non-profitable tech index. And that thing's ripping, every day 2-3%. And meanwhile, your longs, which let's just take value stocks or your industrials and your long energy, they're not going up. Or if they're going up, they're not going up very much. So I think that's what's occurring right now, and it is very much the pain trade. You said it correctly when you highlighted that.
and the pain trade just lasts long enough to wash out the shorts and the weak hand bulls that were too scared earlier suddenly are panicking because they think it's going to miss it, and that's when the market has reached a point where it could make another big move. But we'll see. The one interesting part is, because number 3 was the dollar, I wanted to just highlight one of the huge tailwinds for risk assets has generally been the fact that the dollar has been doing this really deep downtrend. And one of the things of that, if, and I'm not saying we know it will, but if for whatever reason the dollar begins some counter trend rally, then what was a tailwind becomes a headwind. And it'll be really interesting to watch how different risk assets and commodities, especially commodities that were based on a China reopening and things like this, if we suddenly see the dollar counter trend, it'll be really interesting to see how the price action develops there. I don't want to make predictions, but I'm 100% going to be watching how it all shapes up when that counter trend inevitably emerges.
I don't want to make predictions, but I'm looking for the dollar rally like nobody's business and take down the stock market.
No, look, inevitably the dollar will react. It's just the whole question is how low does it first go and when does it actually turn? But when it does, then studying how the other assets react to it is going to be the price action clue. Anyway, I see what you're saying, but I still am trying to be more impartial about it than you're implying. Okay, so let's talk crude oil here for a moment. And crude oil continues to struggle to kind of stay up north of 80. It kind of consolidated there, but overall, I continue to view the real moment when we know that the crude oil trend has changed, when it can not only get back to the mid 80s, right into the trade ranges through the second half of 2022, but that would violate, if I use a thick enough crayon here, this kind of descending trend line, and really potentially start to demonstrate that there could be a change in the downtrend that's been so dominant for the last 7-8 months. And this is such an important moment on crude, because if the bulls can't beat these levels and roll over, then while I'm actually bullishly inclined to oil, but there's nothing technically saying that oil isn't going to go for another retest of its lows or just stay in a muddle for the entire first quarter of the year before maybe a second or third quarter rally emerges. Point is, this is a really important moment where the bulls really need to show that they want to take oil higher, or oil's going to go for one more retest of the downside.
That's some good technical analysis, mumbo jumbo. All right, what's the next one?
All right, gold. Let's. I just, there's so many people like this guy that I know that I do a podcast with continues to think that gold is moving on central bank buying, but right now
Eric thinks that too.
No, I'm talking you. But the key here is that right now, the gold has done nothing but behave almost tick for tick as an inverse trade to the U.S. dollar. And in my mind, I will only drink your Kool-Aid when I start to see gold kind of staying flat or rising when the dollar is not its tailwind. If I see that, then I'll start drinking your Kool-Aid. Right now, to me, gold is still just the strongest cross currency against the U.S. dollar, and the U.S. dollar is weakening. Gold has a huge benefit from it right now, and we're going to find out whether or not your theory is true or not very shortly.
Well, Patrick, again, I'm telling you, I'm giving away some inside information here. Gold is about to explode higher because I lightened up significantly on my gold and silver.
There you go.
There you go. So it's about to take off.
You know what? You're probably right, because I collared the shit out of all my positions.
There you go, folks. Listen, some real value-added alpha right here. Patrick and I are both reducing our gold exposure. You should be buying the shit out of this thing. Just close your eyes and buy it. We're going to make an ETF.
All right. Yeah,
only that's right. The only time it enters into positions is when we both agree on something and have positions.
Yeah, there you go.
And then it goes the other way.
So let's talk bits in the sky.
Oh, come on. Seriously?
I just want to listen. I just want to talk about it. I don't want to make a call on it. All we have to acknowledge it. Like, look, I don't
Really?
own
Why?
well, look, I don't own any, and we know clearly by the tone of your voice that you don't own any either. But I, as a technician, feel it's my job to observe when potential trend shifts are occurring. And what we have to give kudos to the Bitcoin bulls is the fact that they literally in this reversal wiped out almost 6 months of declining price action in one fluid burst higher. And that means that was some very aggressive accumulation. And while I am I'm not going to buy any personally, one of the things that I'm dying to find out here in the next month is whether or not the bulls can dig in and hold all pullbacks above 20,000. If this thing stays there, then those that have laser eyes may be inclined to want to take another shot at this for one more push higher. I'm not going to take any, but
Patrick, it's going to go higher. It's the world's greatest asset. The U.S. dollar is a failed currency. They're going to print to the print. Powell's going to go. Powell's going to go.
Listeners don't know how sarcastic you're being.
And then here, I got to use my new toy. Here it comes.
Okay, here we go.
I got to.
Tonight at 11.
Doom.
I took a sip of beer at the same time you did that. I nearly choked here. Like
I've decided that I'm not allowed to repeat a clip, and because I've got this, and I will want to every time you talk and say something really scary sounding like the market's going down. I want to do that, but I don't want to. No, I won't.
Yes, you should.
No. My rule is I can't repeat the clip on. I'm only allowed one clip per day per show, and I can't repeat it week to week. So, a month from no, because otherwise it's going to get annoying. So a month from now, you might get another one.
All of our listeners can vote on this on Twitter, by the way. If you feel that Kevin should be using that clip more than once in an episode,
it'll get annoying really quick. Like it honestly, it'll get annoying. So that is my rule. I've done it. Right. But listen, there was actually someone on Twitter pointed that clip out to me. It's from Futurama. And I just love it because it just feels like FinTwit is like it just encapsulates everything about FinTwit. So if you're ever looking for something to kind of descend, it's tonight at 11. Doom. I love it. Anyways, that's what it feels like when you talk about Bitcoin, Patrick.
So one last chart for all of our urine eye listeners. We'll talk uranium here, but that's as classic of a bull flagging formation. It nicely set up and it launched higher. The target of this flag, they always say the flags fly at half mast. That $18, which is basically right along its October highs, is a very reasonable target. But this has turned bullish. Unlike we're still in the very early stages of crude oil, which the chart may not even turn bullish yet. But uranium has all the characteristics of accumulation, higher highs, higher lows, price action working well. Just as long as we don't accidentally Gucci, I'm not going to ask you whether you own any. Let's not.
I actually don't own any, so you're good. You're good. I don't know.
Okay. Well,
and
anyway.
You know what? Listen, Cuppy wrote a great article, and just for your information, like just some color. One of my favorite institutional salesman, he sent me something saying, Cuppy's note is getting a lot of traction and everyone's loving it. They're passing it around. It really feels to me like for whatever reason, it's kind of the time for people to grab hold of it. Maybe it's that they have been light on risk and they need something to own, and this is something they feel that's safe to own, but it feels like it might head higher. Like there's a lot of excitement about
and you're on the sideline, which at least gives at least a chance.
Yeah, 100%.
At least a chance. All right. Well, listen, we'll leave it at that. Let's go on to our next segment. So, let's do this new segment.
The new segment. By the way, we have to name the new segment. If anyone has an idea about it, because we don't want to spend like 2 years from now, we'll be like new segment.
The new segment that's 2 years
That would
old.
actually be
It's
very much
really
on brand for us. But okay, the new segment is that we're going to play some clips. We're going to talk about them. Hopefully, Patrick has more to say this time. Do you promise me?
Well, yes and no. I mean, you have like 15 minutes of clips. If we both talk, then it's going to be a 45-minute segment.
I know, but
like,
it's fun.
Listen, I will make very decisive opinions very short.
I'm holding you to that. Here we go.
Year to date, equity
talk over
markets
it, by
have
the
been
way.
absolutely flying. From the Nasdaq 100 all the way over to the Euro Stoxx 50, EM and China for that matter as well. Year to date, the numbers have been absolutely phenomenal. I mentioned Michael Hartnett of Bank of America. And when Michael publishes his weekly flow data note, he puts in there, heard on the street, and just a quote from a client or something like that. And this was the quote this week. I'll read it to you. Another 3 to 5% here will feel like bathing in lava if you're a bear. This is painful for a lot of people the last few weeks, that's for sure.
I thought of you when I heard that. I was like, oh, that's Patrick.
That's the pain trade, bathing in lava. That's
it. I think we should adopt that.
Yeah, that's going to be a new thing. Like we have the prairie dog, the turtle head, and
that's right.
And now
so the pain trade is bathing in lava. Okay.
Lava.
Stupid beer's already kicking in. Okay, let's go to the next one.
Rolls over,
by the way, this is
vice versa.
the Morgan Stanley analyst that I think is just strategist. That's awesome. Here we go.
Good morning, Alex. Now, I mean, look, I think if the economy rolls over into recession,
do you need it louder?
Likely stocks will hold up. That's not priced, and the reason why it's not priced is because we don't know the answer yet, right? I mean, there is an opportunity for the Fed to perhaps orchestrate a soft landing, meaning no labor cycle. But that's, I think, from most people, which is if we don't get a labor cycle because companies are hoarding labor, that's actually going to be worse for margins in the short term. And then secondarily, if you don't cleanse it, you don't really have anything to get excited about. There's no reacceleration then for growth next year.
Okay, so Patrick, what the Morgan Stanley analyst was arguing is that if we do get the soft landing, it will be in an environment where there is no employment stress, meaning that labor will still keep winning. And I am sympathetic to this argument that in a soft landing environment, labor is going to take more than their share of the gains, and we will see capital losing at the expense of labor.
Okay.
Do you have any thoughts or comments?
No, because it makes sense. I mean, the fact is that wages and labor have been less and less of an impact on the economy, and there's a lot of people that were saying that the next wave is anyway. I agree.
Okay, here we go. So don't be afraid to talk over.
Yeah, I mean, what it always comes down to is earnings. I mean, earnings is the hard data series that drives stock prices the most. I mean, we've always said that, and we continue to believe that. So we're just trusting our process, which is that, the leading indicators for the hard data is soft data. And the soft data has rarely looked this weak. So you have to be basically assuming it's different this time for the hard data not to follow. And, that's not a position that we want to take, particularly given that we just had a rally over the last 3 months, which has been spectacular. We sometimes get coined with being perma bears, but last time we called for that rally in October. And we basically got chased off the screen then. So, what's amazing to me is very few people wanted to play that rally in the fall. And now people want to play it after it's already happened. And
okay, so I want to talk about that because that's actually some great points.
We've heard, when we had David Rosenberg on the other show I cheat on you with, he echoed many of the same types of views, which is it's just still too early in the cycle. Go ahead and kind of give your view.
Well, no, but one of the things about that fellow is that he's always bearish.
Oh.
Morgan Stanley's sitting there and he's telling you that he got chased off the screen is what he's saying when they got bullish last time. And now all of a sudden we're getting a situation where the market's rallying and everyone's bullish and he's bearish. And it's just kind of the nature.
Is that Wilson?
I believe so. I believe so. And it's just awesome. I think it's some great analysis, and I think it's terrific. And when you look at the valuations here, it's tough to get really excited about it. This is a liquidity rally, and that is what's happening. But in terms of the market, it's expensive. Anyways, let's keep going because we got a lot to go through here, as you said.
Last thing I would say about that is what people are getting most excited about are three things. Confluence of China reopening, which is good, and we agree with that. Secondly, gas prices have come down precipitously in Europe, which is maybe keeping them out of a recession, at least in the near term. And then you have the hope for a Fed pivot, which is also a call that the Fed's going to pause after this next meeting. But
I don't know if I agree with that.
All those things. You know, the valuation now does not reflect the earnings risk that we still see in the U.S., which is not going to change from any of those three developments.
All right.
Yep.
So I think that that's a really great point, is that all these things that everyone's excited about actually don't change the risk about earnings going forward.
Yep. I mean, I think that China reopening is a tailwind for a lot of China-driven things, but that doesn't necessarily, like whether commodities or other elements might influence currency markets. But I think U.S. corporate earnings are not going to get a huge tailwind from that.
Patrick, we're going to give you a job at Morgan Stanley in the strategy department. Because listen to this.
But on that point, Evercore had a note over the weekend that said that a China reopening is in the early innings and could unlock $1 trillion worth in excess household savings. Either you disagree with the number or you think that that's already priced. That amount is priced.
Well, first of all, there's a timing to that. Okay, so that $1 trillion is going to come out in the next 3 months. Number one, our intelligence and our sources would tell us that consumer confidence in China is still very fragile. So yeah, they're reopening, and that's a good thing, and it's going to get there. But the average consumer is still skeptical. They're still a bit scared of the virus.
I'm not sure I agree with this part, but anyways,
play out. There have been increased death rates, et cetera. So it's going to be slow. So that's number one. Number two, I would say,
this is
we're going to work on this. We think China's reopening is good for China. It's going to be very good for the Chinese stock market. We're bullish there. But it's not going to necessarily drive revenue and earnings growth in the U.S. And that's what I was saying earlier. China basically is 3% of the S&P 500 revenues. So, even if it is a faster reopening, it's not going to move the needle in the short term.
I think that's such a great point. Patrick, you were way ahead.
Well, anyway, I'm not going to say anything else. But it's going to influence commodity markets. It's going to influence some of the bigger macro. But I still think that the Fed policy and monetary policy, fiscal policy, all of these things are way more important than a tailwind from a China reopening on U.S. earnings. Anyway.
Oh, I completely agree, Patrick. And I think we're way ahead. And in fact, I think if you think about what China might affect, I think energy is probably the easiest one of them all. They're all of a sudden, they've been sitting at home and the amount of savings is huge. They're going to get out. By the way, I had a subscriber talk about this in my chat and in my Macro Tourist chat. He said he was in a mid-tier China city, which is 7 to 8 million people, which just kind of boggles my mind in itself. But anyways, and he said that everyone's had COVID. It's gone through, and even in the rural environment, it's gone through. We're going to be surprised at how quickly COVID is cycled through China, and then how the restart. I almost wonder if part of this rally is in essence that liquidity coming into the market.
I've never made sense of the China lockdown. I'm going to put on my tinfoil hat, but the rest of the world, we already know what COVID is and how it impacts. The fact that China kept the lockdown going, I think there's something else to it.
Save it for the other podcast, buddy.
Yeah, I was about to say my tinfoil hat. I just took it.
Here we go. Stop it.
We've actually centered on Asia as opposed to Europe as the place to be, but the charts don't lie, right? I mean, they basically are showing the relative strength in EM over S&P, as well as Europe over S&P, which is the first time in recent memory.
This is talking your language, Patrick.
We think it's a function of a couple of different things, Guy. Number one, exactly what you said, the relative growth profile maybe is improving outside the U.S. But number two, in October, the big tech stocks, almost all of them had a really difficult time with earnings, and the stocks came down sharply. And we think that money is now being reallocated around the world, and that could be persistent. That could go.
I think this is
years for that capital to be redeployed in areas of the market, global market, that are much more attractive.
This is such an important point.
So, on that sense, for U.S. tech, how much money do you think still has to come out of those guys?
Well, we don't know, obviously, but what we do know is that the capital concentration that's occurred over the course of the last really decade has been somewhat unprecedented. Maybe the tech bubble was the only other time. So it'll be persistent, okay, particularly if relative strength continues to underperform. And if you just look at those charts, because you did start off this presentation by looking at technicals, I mean, that's probably the strongest technical I can see is the relative underperformance of that sector compared to everything else. I mean, it's the mirror image of what we've experienced in the last 7 years. And to think that that's all completed now, I think would be naive.
All right. So my call is that it's only when the Swiss National Bank has sector rotated all of its Apple holdings into Credit Suisse that we're going to have the bottom of the tech story.
Yeah. And I think, listen, right now, that narrative is wrong. And that narrative worked all last year, and it's not working right now. There has been a return to tech. NASDAQ is leading. It's all the things that everybody was short because of what Mike just mentioned have been rallying. There will reach a point, and I don't know where it'll be, whether it'll be this week, next month, or in 2 months, but there will reach a point where this bear market rally in tech versus the rest of the market extinguishes itself, and that trend will continue. And I am 100% behind Mike in that this is a long-term trend with everyone way, way, way overweight this thing. And this will be something that takes years to unwind. All right, let's go to the next one. This one's a little bit of a fun one. It's for the old timers. There's going to be a little bit of music.
All right, let's just see. Okay,
here we go. Hopefully it comes quickly. I'm still working on the time between the stuff. Here we go. All right. Now, for the old people listening to this, they're going to instantly know what that was. Question to you, Patrick. Do you know,
absolutely no clue.
Really? You did not, honestly, you didn't listen to this?
No.
Oh, I'm surprised. Okay, let's play the rest. Maybe you'll recognize it when there's more. I'm actually really surprised. What did you do when you were 12 years old? Weren't you watching this? I can't believe it. For the old folks, they're going to love this. They're going to be so excited about that. So, for those who don't know, that's Wall Street Week with Louis Rukeyser.
Okay.
And it was one of the greatest shows ever. And it was public broadcasting, and he literally just got people in to talk about stuff. And what I've done is I've dug up the Friday before the 1987 market crash.
Yes,
that's
awesome.
So we're going to play this. We're going to talk about this. We're going to start with Louis just kind of setting the stage. And one of the things that I want to stress is that Friday, the market had already gone down a long way. And a lot of people thought that the correction had actually occurred and that it was over. So let's play it and see what happens here.
Good evening. I'm Louis Rukeyser. This is Wall Street Week. Welcome back. The stock market, we are told, is always delivering a message. The only trick is knowing how to read it. Well, this week, no great cleverness was required to catch the message coming from the stock market. That message was, help! Last week, the Dow Jones Industrials had recorded their largest point loss in history, down nearly 159 points for the week.
This is before the crash.
It seemed extremely unpleasant. In retrospect, though, it is beginning to look like a joyride. For this week, the Dow crashed more than 235 points and set a bundle of other nasty all-time records in the process. Just as a sampler, to help make your weekend merry, consider these nuggets. A week ago Tuesday, the Dow took its worst one-day point hit ever, more than 91 points. It managed to beat that twice this week, climaxing today with a 108-point mauling that occurred in the heaviest day of trading in the 2 centuries of the New York Stock Exchange.
Think about that. Friday, they're talking about
38 million shares.
The biggest volume day ever.
How about this? All the broader market indexes also had record point declines today. The week's trading on the big board was itself a record. And as for that long-deferred correction, the Dow had not had so much as a 10% sell-off in more than 3 years. The index was off nearly that much this week alone and has now fallen 17.5% since its peak less than 2 months ago.
Okay. So now that's just setting the stage for that Friday. You're just think this is hilarious.
No, but you know what? No, I think I'm going to start using that in my chart analysis. This price action is just saying, help, help.
You know what's really funny is I was watching the video, and he's got this suit, and it's kind of gray flannel, and I was like, oh, I remember, and that was really cool. I haven't seen one of those in ages. I was like, oh my God, I do remember that. Okay. So when I was a kid, I remember watching the show. This was awesome. You'd go watch it on PBS or whatever. But the interesting part is I also remember reading a book and learning how people thought that this was the long-awaited correction had occurred this Friday. And it was down, whatever it was down. And I even heard of people having parties because they're like, oh, finally the correction's here. Now we're okay. Now, what I've done is this Wall Street week with Louis Brookhiser is just, it's famous because there was one of my all-time idols on there, which is Marty Zweig. He called for the crash. And he actually started the show out with this crash call. But I thought it would be more interesting to play the more traditional, what everyone else was saying view. Because don't forget, market is down 20%. It's tough to come out and say, yeah, it's going to get worse, right? So I'm going to play the other two guests first, and then we're going to do Marty. So let's start with the other two guests. And I think this other guest ended up being actually...
Oh, Marty, in his affable way.
Very famous.
Nasty word crash.
Mary Farrell, I believe she ended up being quite a strategist.
And I wouldn't accept the estimate that the bull market is over either. Certainly we're in a correction, and that's been more than obvious. And I think you have to remember here that we're not dealing with real buyers and real sellers making real buy and sell decisions like in the old stock market, because you do have this...
Okay. I just got a comment on her haircut. Say almost fire. That's all I can say. Okay. Now, the other interesting part about this is she's talking about... She's talking.
This 12% beer is kicking in.
Yeah, I know. It's actually, we should never do this again. The other interesting part about this is that even though we all think about 1987 as being this period when it was so antiquated, it was all by hand, blah 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 blah. You listen to this, and they're talking about all the problems with the computers, and this is a theme that keeps coming up over and over again. So it's interesting to put it in context because everyone always thinks the new technology is this terrible thing that's going to cause this. But that story is as old as time. Here we go.
Computerized program trading and portfolio insurance, really making these very extreme, very rapid decisions.
May I ask you a question about that?
Yes.
These computers are used by large institutional investors whose money managers are paid huge sums of money to make no-brain decisions that are made for them by computers. Aren't these guys overpaid?
Oh,
Louise,
you're such a card.
Yes, did. Tell us why you don't think the bull market's over.
Well, I think interest rates are the real key here. At these levels, we'd have to see some interest rate relief to see the bull market continue into another leg. And I don't think that's out of the realm of possibility. We could see some rate declines by next year, and that would certainly be a positive. At these levels, though, I was Marty, we're in for some rough sledding, and the risk here really is that interest rates don't give you that relief, and then you would continue with more of the same.
Lou Holland, we have...
Next guest, here we go.
We have one extreme negative, one reassurance. How do you vote?
Well, I'm more positive, I think, than either Marty or
Louis
Mary.
was wrong.
In that I think we probably had 90% of the decline. I think it's possible we could go lower here over the next week or so. But I think sometime between now and maybe the end of the year or the end of the first quarter, that you'll see the market in excess of its recent highs.
What do you base that on? Why do you disagree with
Well,
that?
I would agree with Mary in that I think we're due for a rally in the bond market. And I think we will see some improvement in terms of the trade numbers as we go forward here. And corporate earnings, I think, are going to get better as we go forward also. So I think that interest rates probably are the key to the extent that through the first half of the year, or really through the first 9 months of the year up until recently, the bond market and the stock market had moved in an inverse relationship. Now I think you will see somewhat more coupling of the two, and I think that interest rates probably will rally sometime over the next several months, and I think we'll enjoy a nice recovery when that occurs.
Let's hope we're all still solvent when that occurs.
Voiceover, they're not. Okay, so a couple of interesting points about that. First of all, how he highlighted the negative correlation between stocks and bonds. And I don't think enough people appreciate this, but into the 87 crash, the bond market was trading terrible. Like it really was. It was getting crushed. And it was ultimately that bond market that kind of was the competitor that might have caused the crash. But it was interesting that both of the bullish commentators used the bond market as an excuse to buy stocks. They were like, oh, it's okay. The bonds are going to get better, and that's why stocks are a buy. And well, the reality is stocks got a lot worse, and that's why bonds got better. That's the first thing. And then the other thing is that it was kind of interesting how he said that we're 90% done. And I just want to set the table that this, while we're talking about Marty Zweig, and he said, like, in hindsight, this is going to seem like such an easy call, but it wasn't. It was very difficult to come in there with the stock market down 20%, get on national TV and say, I'm still bearish, which is exactly what he did. And listen, he's one of the greatest analysts of all time. He did a lot of things that...
Tonight, many commentators have been saying, to quote one analyst, that the bull is dead. Marty Zweig is one who has been correctly worried about this market lately. Do you agree with that comment?
Yes. But I haven't been looking for a bear market per se. I've been really in my own mind looking for a crash, but I didn't want to talk about it publicly because it's like shouting fire in a crowded theater, and there's other ways to play it. You just tilt your strategy negatively and you shut your mouth.
But then you get on PBS national TV and tell everyone it's going lower.
And I think we're in the middle of something reminiscent of 1946 or 1962, which were very similar, and to some extent 29, but it won't be as bad. And I think we're in the middle to somewhat beyond the middle of this break. And there'll be some violent rallies, though. In fact, probably early next week, I expect a violent rally.
But that would not change your long-term estimate that the bull market's over.
Well, I don't look for a long bear market here. I only look for a brief decline, but a vicious one. In 1962, the damage was done in 2 months. In 1929, it was done in, mostly 10 weeks. And I don't think it's going to drag on any longer than that here, but it just will go down more and then turn around.
Some people say it's a bear market if you're off as much as 20%. We're nearly there now. What's your definition of a bear market?
Well, it would be a bear market, but I think of a bear market 1973, 74, where it's drawn out for quite a while, whereas a crash is something like 46 or 62 that's over in, say, a month or two. That's, to me, the difference.
How should people play it?
Very cautiously. You're going to be hurt no matter whether you're bullish or bearish. There's too many traps to fall into. We should have a selling climax and probably two of them. And after a selling climax, they always go back lower. So we're probably going to have, I'd say, 3 gigantic rallies within the next month or so, and every one of them could be a trap. Except the last one. Of course. But whenever that comes, you don't know. It's hard.
All right. So,
oh my God, he's so smart. But actually, I like the way he articulated that.
Yeah, no, it's terrific, and that's it. Listen, that's all I wanted to kind of highlight. I did think it was interesting. He thought it was going to be a couple months or maybe a month. It ended up being a week. It did definitely get accelerated, but wow, what a call! I
know this one guy that I do a podcast with. I'll let you guess which of the two podcasts, but the market's down 20%, and he just thinks the market's just going to go sideways. It's I don't know, he.
I have this guy that I do a podcast with that thinks he's Marty Zweig.
Oh,
Okay.
if only. If only.
Exactly. All right. That's it for the news segment. Please send us a name so we can figure out what to call this thing.
Yeah,
And-
we got to call this segment something. So someone's got to give us a good name for it.
That's right. Okay, let's go to the bets.
Yeah, skin in the game.
Right.
Unbelievable that I was winning this morning. I'm gonna put copper on here in a 1 hour chart.
Okay. So
And
our bet
just-
last week was that it was going to close above or below 4216. And which way do you
It
chose?
was 4216. I took down, and you took up, and this morning it was down.
Yeah.
And it was down to like 418.
Do you know how many contracts I
and-
had to buy to get the thing back up above 4216?
It's time for your confessional. to admit it. How much did you have to buy 3 points?
I had to buy 1,000 cars. No, I don't.
But you know what's going to happen, right? It's that Monday morning it's going right back down, and it's like you literally.
Yeah. No, listen, I
by the skin on your
I
teeth.
fully accept that I will.
Or was it the hair on your teeth, as I would say before?
But listen, you were close, but close only counts in horseshoes. It does not count here.
No, you got your 3 points.
Yeah.
Buddy.
So what's the score?
I don't even want to look. Hold on a second here. It's 32-22.
Ugh.
It's
Do you know
looking
what?
good for you.
I just
bud.
realized I haven't made a bet. I have no clue what to bet on. Oh shit.
Oh,
Let me think of. Okay,
why don't you do it on the coin?
Let me.
do it on the bits in the
okay,
sky.
we got to do it there. Okay. Let me tell people about the game. Skin in the Game is our weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager. The other guy chooses which side of the bet he wants. Every wager needs to settle by next episode, and we're going to play a match up to 50 points. At 50 points, one of us is going to end up taking 3 Market Huddle listeners out for dinner. And
at the other one's expense.
Is that what's going to happen? We never talked about that.
No,
I thought we were going to actually get some advertising. We don't really have any advertising, if you haven't noticed. I thought we were just going to get some advertising and blow it all on that.
No, the loser pays for the winner to have dinner with the guests.
I got to pay attention then. Okay. It's okay.
So
Bits.
Right now, it looks like my credit card is taking you out for dinner.
No, I'm really scared about this bits in the sky though, because I'm worried you're going to take the other side.
Well, it's entirely possible. This is where you have to price it right.
Jesus Christ. Okay, so we got to do the bits in the sky. Like it definitely. So we got 2 weeks for the bits in the sky.
Yeah, the 2 weeks.
Okay, so I'm gonna give up some edge here because I want to make sure I'm on the right side of this bet. And what are we at? 23,100.
Yeah.
Above or below 22,000.
In 2 weeks. That's actually a really good thing because while I think the trend has actually potentially turned bullish, the rally has to be checked. And even just a 50%
Yeah, but think about it. It's 2 weeks, man.
Even a 50% retracement over 2 weeks could take this thing to 20,000.
Okay, so let's do another bet because I don't want to be betting positive on Bitcoin. Let's just against like it may.
No.
Tough
luck. You made the bet.
Well,
you made the
well,
bet.
I'm only bet 1 point.
You got a 10-point lead. You got to let.
No, I'm only going to bet 1 or 2 points.
You don't get to choose. You made the bet.
I know, but you're going to choose your side, and then I get to choose how big we bet.
Okay, let's do it. We already made the call. 22,000 over under. I'm taking under. What do you do?
I'm only doing 1 point. I can't bring myself.
No, 2 points. You got to give me a chance to get back in the game.
Fine. You shame me into it. 2 points, bastard.
All right.
You know Bitcoin's going to 30,000 now.
It does. It probably will, but not before I take my 2 points from you,
bastard.
All right, the bet is done. Listen, we're not doing no stupid questions segment, but those of you, Lena, jump on here. If anyone wants to submit their questions, where do they submit them to?
Please submit your questions to nostupidquestions@markethuddle.com.
All right, that
was very clean and decisive. No, but Point is, we're gonna do questions again next week. We just this episode's dragging too much, so we're keeping it short and sweet.
Patrick's talking.
So,
it's Patrick's talking
close.
charts problem. Okay, thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow on Twitter at the Market Huddle. Lena's there. She gets tired of talking to Patrick and myself every day. You can listen to the Market Huddle at all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest contents. Patrick, where can they find you?
You can follow me on Twitter at Patrick Srusna, and you can follow me at bigpicturetraining.com. And Kev, where can they find you?
You can go check me out at Kevin Muir, or sorry, no, that's not where you go. You can go to at themacrotourist.com, and this beer is really actually very much kicking in. And you can check me out on Substack. And on Substack, we have a chat that's going on, and you can go download the app and you can go into our chat and listen. If you got a market view and you're going to be kind to one another, you're more than welcome. It's a great place for people to share their views, and I encourage you all to come. Listen, we can never have too many friends, bull market, bear market. We're just happy to spend some time together on this crazy ride. Now stick around for the after show, or if we're going to have one. Thanks for tuning in.
So you, well, we are going to rate the beer here.
Oh yeah, that's right.
But you said beer without adding the Z at the end. The beers.
The beers. So I definitely I drank it all, which is unusual. Usually I kind of sip this crap and I don't do it, and it's 11. And I could tell from you were giggling a little too much too. I hate myself for this, but I'm going to give this thing a good rating just because it's deceptively good. I'm not going to wimp out and say for an IPA like you do. I'm just going to say, I don't know what I'm going to say. I'm giving it an 8-1.
A what?
It's crazy. I don't even know. It's not even a beer. It's not a beer, but it's good. Lena, I heard you should try one day.
The
Lena,
Space Age Sunshine Orange Creamsicle. But to be honest,
does it actually taste like orange creamsicle?
I don't know. It just tastes like alcohol because it's so strong.
Yeah, it really just does taste like.
What is the percentage? Sorry,
11.6%.
Holy
but it's
shit!
Exactly,
it's 2.5 of regular beers.
It tastes
beers
like a high alcohol,
not a Z,
IPA. The orange is a very mild,
I don't care. I like it. I don't care. What are you giving it?
You know what? No, I'm not with you, bud. I'm not going to give it a horrible score. I'm going to give it a 6.9.
Oh no, that's a bullshit score. It's better than that.
It?
What do you mean? I use 7.5. I only rate something under 5 if it's horrible. Yeah, of course, beers. But I don't want to give it over 7.5. 6.9 is my score, and it's a very strong IPA. If you absolutely must get smashed in one beer, except no substitute.
But did you finish it?
Yes. Beers.
You're like those people that at a restaurant that orders a really expensive dinner, eats it all, and then goes, you know what, it wasn't very good, so I don't want to pay for it.
No. Are you saying the only way I could give it a 6.9 is if I didn't finish it?
Lena, isn't the joke that food is terrible and the portions are too small? I think that's the joke.
It's got to be better than the score you're giving it if you finished it.
Yeah, I'm with you. I agree. Patrick, there's
I would have stopped drinking it if it was that bad.
Look, I am allowed to give the score I want to give. You guys can't criticize me for my score.
Of course you are. You can do whatever you want, but that's a bullshit score.
Oh my God.
Yeah, that's a bullshit score. And not only that, Space Age Sunshine, it's like trying mushrooms. It's just... Anyways, I'm just joking. It's a good beer. Go try it out. Do you guys want to talk about anything, or should we just call it a day?
We don't have to rush off, but we don't. I don't want to make this a half an hour after show here, but we could talk.
Where are you, Patrick?
I'm in Playa. Del Carmen.
So Patrick was bragging to us earlier that he had his first celebrity sighting.
No, it's not first.
Come on.
I thought he saw
two in one day.
Yeah, I know. I thought so too. And then we found out it was the other way around. Someone thought he was a celebrity.
I just had no. Stop it. You using the word like it's. I just had shout outs. It's like Patrick Ceresna. Like what?
In Playa.
Yeah,
someone recognized you. So, and the best
2 people in.
So
in
listen,
in
the
a
best
day.
part of this story, and it just sums up who Patrick is. Okay, some rando sees him on the street, goes, "Oh, that's Patrick Ceresna," shouts out. Patrick goes drinking with them all night.
Yeah, absolutely. I said, well, let's meet up for a fucking beer. It was like someone recognizes me.
They deserve a beer. Listen, that's all you got to do. It's like Where's Waldo? It's like Where's Waldo, but there's beers at the end of it. Where's Patrick with beers?
All right. That's funny. What's anything new with you guys?
Nope. I guess not really. Pretty boring
It
stuff.
snowed in Toronto.
Yeah, it snowed a lot.
Oh, it's January and it snowed. Like let me just put my shocked face on.
Yeah. Well, actually, Lena, we were talking about this on our desk. Don't you think that in the old days, like 10 to 20 centimeters, like that's nothing, and people were losing their shit about this, and we're like, we've gotten soft post-COVID.
Oh yeah. I remember when it started snowing. Was it Wednesday? And I was like, why are people freaking out? Like this happens every year.
Yeah.
Every year this happens.
Like 50 or 100 centimeters. That's a snowstorm. This is just like a dusting.
Yeah, like I'm sorry, you have to go look at pictures of Buffalo, New York, and that's where
no, those guys.
Those are snowstorms.
Yeah, the amount of snow that they get because of the lake effect, how it comes from the north, and then it's unbelievable. They're way tougher than Torontonians.
Absolutely they are. Yeah. Like Torontonians get like 1/5 of the snow that Buffalo gets.
Yeah, it's unbelievable what they have.
We're spoiled. We're spoiled.
I think it was like a proper snowfall, first snowfall of the season.
I'm so spoiled that I'm spending the winter in Mexico.
This is the guy that's... those Torontonians sure are wimpy, as he says as he sips his margarita from
and getting a sunburn in the sun.
What's the place I told you guys to go to, and then Lena was in Mexico and you guys went together?
Well, it's no. You're talking about
Senior Frogs.
Yeah,
Frogs.
And I couldn't believe you had never gone to Senior Frogs.
No, I walk by it now all the time, and it's
you go.
I don't
all
go
the
in.
time.
It's a student bar. It's a student bar.
Bullshit.
I can't do it.
Bullshit. You go all the time.
I don't go. But I walk by it. It looks interesting if I was 20 years old.
Yeah, I hear you. There's a guy on our desk. He's kind of he's in his 30s, and the other day he was talking about. He says his friend's in town, and he says we're going to the XYZ bar, and I said, "Are you shitting me?" And he's like, "No, why?" And I said, "Because I drop my kids off there all the time." How to feel old, Kevin Muir edition.
You're gonna go bump into your kids after work at a bar.
Okay, and I get one more story, and then we'll end it. So we're sitting there, we're chatting about stuff, and we're talking about our favorite movies, and someone brings up Shawshank Redemption. Great movie. One of the guys that's generally pretty quiet, keeps to himself, doesn't really have a lot of opinions about like movies stuff, says, "I fucking hate that guy." And we're like, "What?" He goes, "Fucking hate that guy." And we're like, "What?" And we're thinking like that he maybe doesn't like his acting or something. And we're like, "You mean like Tim Robbins?" He goes, "Yeah, I fucking hate that guy." And we're like, "What did Tim Robbins ever do to you?" Turns out that this fellow lived in New York City, and he played in a kind of a recreational hockey league. And Tim Robbins is a big hockey player, and he did the thing where he what is it called, Patrick?
Slew footing.
No, when you take your stick and you butt end the guy.
Well,
butt ending, like you know how you take.
Yeah. You take it into his rib cage or something.
Yeah, exactly.
But I don't know what it's called. Like no, slew footing is when you throw the hockey stick behind the heels and you.
No, this was the old butt ending with the thing, and we were just laughing ourselves silly because he's like, "I fucking hate that guy." And he just wouldn't talk about him. He's just like, and he's dirty. He plays dirty, and it's like,
wow.
So listen, Tim Robbins. If you listen to the show, which maybe he does, maybe he's a Market Huddle listener. If he is, just reach out to me, send me an email, and we'll hear your side of the story. But in the meantime, you're a dirty hockey player, which for Canadians, there's nothing worse. You don't
That's why everyone hates Brad Marchand.
Yeah, you don't butt end people. That's bullshit. That just doesn't happen. You deserve to get the snot kicked out of you just because you're 6'5". You think you get away with it, which you probably can. You can get away with that shit.
He's
on
6'5"?
Oh yeah, he's big.
I know he's tall, but he's 6'5".
Yeah, he's 6'5". We looked him up. Anyways, bullshit. Absolute bullshit. I don't know if I can go into the I'm not gonna like Shawshank Redemption, but it's close.
No,
it's close.
It's close, eh?
Yeah, it's close.
You've been turned.
Listen, I trust the guy. He's on my desk. He's not gonna lie to me. I'm pretty sure that Robin Williams.
Yeah, but you know what? That doesn't make it. The movie was still good.
I don't know. The guy butt ended to someone. You got to have standards.
No. You don't have to like the actor as a person. You could still judge the movie for what it was.
I don't know. It's kind of like saying you like Michael Jackson's music. It's tough. It's tough.
Oh my God. I'm tapping out here.
Pedophilia and butt ending someone in a hockey game, recreational hockey game, very close.
Oh my God.
Okay, we better leave it there.
Yeah.
All right. Okay. Have a great weekend, guys. It was a good episode.
Send your cease and desist letters about from the Michael Jackson estate to markethuddle.com. Have a nice weekend, everybody.
Okay, cheers.